I'll be surprised.
Does anything get done in Washington in June? It's the oddest month. It's like it's not 100 degrees yet, and now we all have air conditioning and all that. But the heritage of the city, am I right? Nothing gets done?
It's very little gets done, and I think the framers of the Constitution sort of decided to place the Capitol in Washington so that it's so warm there, Congress doesn't meet, so they don't do anything in the summer months.
In all your experience, I mean, it's basically 1920 or 1820 for that matter, isn't it?
It is. But, you know, I will say that it looks like this whole infrastructure issue is going to come to a head pretty soon.
You think it's going to come to an it's interesting?
Yeah.
Well, and that's actually an interesting, exactly where I wanted to go, this idea that people are already pricing in some sort of infrastructure spending plan. What's the contour of this particular plan, given the bipartisan effort that's taking shape?
Well, I mean, I think this meeting with Senator Caputo and Joe Biden this Wednesday is going to be critical. The issue, obviously, Jonathan has talked about this all the time, they can't even define what infrastructure is. If they're able to come together with a definition that works for both sides, then the big issue is how to pay for it. And that's where there is a deep fundamental philosophical divide.
What's the latest headline number that you keep getting from sources?
I keep getting somewhere south of 1 trillion, if they can agree on a number like that and agree to how to pay for it, then I think you're going to get a deal.
Marty, got to leave it there. Congress getting back to work in the next week. Marty Schenker there, Bloomberg editor at large. Some breaking news for you. A share sale from AMC Entertainment. 8.5 million shares for $230.5 million. Looking to use the proceeds from this, Lisa, to maybe purchase some theatre assets and leases, and maybe looking at deleveraging opportunities as well.
Yeah, that's a key issue, as you were talking about before, that they need to reduce some of this debt to give themselves more flexibility going forward. My question is, what is their business model going forward? Is it just going to be movie theaters? And if so, does that look the same post-pandemic as it did pre-pandemic? I mean, do people want to go back to sit in movie theaters?
No idea, but one thing they're looking to do in the near term is take advantage of a massive equity cushion and a big rally that's been taking place. Tom Keene in the pre-market, AMC up by 6 percentage points, up by 6.32%.
It's a bull market and odd things happen. I can remember a few years ago where you were attracted to prime brokers if they could offer you Krispy Kreme to short. And then Krispy Kreme was put out of its misery, and now we have Krispy Kreme thinking IPO.
They've filed publicly for an IPO. I don't think they're thinking about it, Tom. I think it's happening.
All things Krispy Kreme come full.
You don't sound bullish about this, I've got to be honest with you.
No, actually, I sound hungry about this.
Yeah, Tom's way of breaking news is really gold.
Dunkin' Donuts to come out with headlines.
Well,
right
TK,
now,
I think your word choice was interesting there. The phrase you used, bull market. You weren't talking about bubbles. You were talking about a bull market. Just a consequence of a bull market.
Yeah, I'm distant. I'm removed from it. I'm in triple leveraged all cash, and I'm happy. I mean,
are you happy?
My downside
still
risk
looking
is
for an
hedged.
entry
He
point.
sounds miserable this morning, I've got to say. AMC, part of the story this morning, then up 6% in the pre-market. Krispy Kreme filing publicly for an IPO. And when you look at the weightings, just quickly, TK, the weightings of the Russell right now, the number 3 weighting on the Russell, GameStop. The number 8 weighting on a Russell right now, Lisa, AMC Entertainment.
Yeah, and the idea here that AMC Entertainment also has been a meme stock, right? So how much are people going to end up benefiting from this? But you do think about some of these key players being such big weightings of these indexes, what that does.
I'm not ignoring you, Tom. Just the punchline should come at the end. So just inching towards the end of the segment to give it a punchline. Go ahead, please.
There was so much rain this weekend, kennel fee started quacking like a duck.
Okay, is that really what you wanted to say?
Yeah, that's really what I wanted to
If I'd
say.
let you say that 60 seconds ago, do you think that would have helped the flow of the program?
It would have helped, smarten up the program here.
You didn't think I was going to have a punchline?
No, Lisa, I thought you'd add some value, which you did. Coming up.
Sterling, the Prime Minister got married.
Tiedemann Advisors Managing Director. You and I weren't invited, Tom.
How's Mayor of Easttown, Tom?
42.21 on the S&P. Lisa, you know he's watching now.
I know.
Up 0.4% to 1% on the S&P. Equity's doing okay to kick off the month of June. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
.30 in New York this morning. Good morning. Kicking off the month of June, your equity market looks like this on the S&P, advancing 0.4%. On the Nasdaq, up 0.4%. On a Russell, up 0.6%. After a slim month of gains for the month of May on the S&P 500, the banks, and that rally continued, up by more than 5% on the S&P 500 bank sector through last month. If we switch up the board and get to the bond market, payrolls coming up on Friday, 650,000 is your median estimate. Yields going into that higher by a couple of basis points on a 10-year to 161.98, up by 2 or 3 basis points on the day. Over the last couple of months, though, we've talked about this continuously. The amount of stability you've seen in the nominal yield since we topped out at 174 on a closing basis at the end of March has been pretty phenomenal, hasn't it? When you think about it, your average has been about 161, 162, and that is where we are again this morning. Let's finish on this. The news that the OPEC Plus team are looking for a tighter oil market in the second half of this year, and a rally going into an OPEC Plus meeting a little bit later, up by 2.65% on crude. WTI with a 68 handle, Brent with a 70 handle. Your year-end estimates still 63, 64 on WTI and about 68 on Brent. South of that, of where we are right now, Tom. Brent 70, WTI 68. When you're looking at the forecast, some people still doubting this could continue.
It's going to have to see. And, frankly, it's a more active market than I expected on a post-Memorial Day Tuesday morning, John. And there's a real correlated lift here, again, with that commodity lift dovetailing right into an equity lift. We start strong this 1st of June, and we do so with the right guy at the right time, because we didn't know over the weekend that China would profoundly change a birth policy from 1 child to 2 child to 3 children. 3 bouncing babies. Robert Hormats joins us with Tiedemann Advisors and their managing director. And what is so important here, Bob, is the arc of your service to the nation goes back to Nixon and truly the opening of China in the 70s. Explain the baby policy long ago and far away.
Well, it's a very interesting change because, as you correctly point out, Tom, traditionally they've had a 1-child policy to avoid a very large continued increase in population. Now their population is turning downwards. They want to keep an active, vigorous workforce, so they're now permitting people to have 3 babies. And a lot of Chinese families would like to do that. That's part of their tradition of having large families, one of whom takes care of the parents, stays in the village. So it's not, this is culturally sort of going back to China, maybe 50 years ago.
That's right where I wanted to go, Bob. This is really important. You mentioned the culture of China. Is America, in its bipartisan policy to China, blind on the culture of China?
Well, I think we need to understand it better. A senior Chinese once told me, your understanding of history in the United States, the way it's taught, really starts at Athens and moves west. It's Athens, Rome, and all the things that go on in Europe. Whereas a whole portion of the world, the Middle East and East Asia, had their own cultures and their own histories. And China's is 5,000 years old. We have to understand that that culture is not going to change, and they've changed their government since the revolution in 1949. But the culture of China is a very deep one, and one of the things we have to remember is education is a critical part of that. It has been for centuries and centuries, and it will continue to be. And we're dealing with a country that is very formidable in its emphasis on education, and now and particularly in technology education.
Bob, do you think that their perspective on history is what led us to believe that we could get them to become more like us? The Western governments could get China to actually adapt the system that has driven the growth of the last 50 years?
That is right. And I got to know Deng Xiaoping quite well during the period that he was in power. And he said, we can learn. One of the major things I've done is to open China up. The universities were closed for several years during the Cultural Revolution, and Chinese were not permitted to study, many Chinese were not permitted to study abroad, including the United States. He said, now we'll be able to open the universities in America, and Chinese will be able to study in America. But he said, one thing to remember, we will learn from you technology and a whole lot of things. You have a lot to teach us, but it doesn't mean we're going to change our system. And he said, you have to make the distinction between learning from you and that causing us to change the fundamental system of China, which has been based on 5,000 years of culture. So we have to understand, a lot of Americans were naively of the view that once they became a more market-oriented economy, which they have, they're also going to move toward a democracy. And that the Chinese, even early on, said that we have our own way of doing things, and because we move in one direction economically doesn't mean we'll move in a democratic direction.
Bob, that word you used, though, naive. When you look at the approach from this administration, do you sense continued naivety?
No, I think the people in this administration, Jake Sullivan, Tony Blinken, Kurt Campbell, have a very good understanding of China. They've worked with China. I've worked with them very closely. Jake and I went to China several times with Hillary Clinton when we were in the State Department together. Tony Blinken has been there with Biden when he was working for Biden. Kurt Campbell knows China as well as anyone. These people are not naive. They're very knowledgeable about China, and I think the Chinese respect the fact that they understand China quite well.
So then distinguish what their approach is to President Trump's. In other words, what they want to accomplish with their Chinese-U.S. policy that perhaps Trump did not.
Well, I think the tone has changed quite a bit. And I think they want to do two things. One, they do want to have a good dialogue with the Chinese. I mean, they've said that. I mean, the first meeting didn't get off to such a great start, but it was certainly a meeting. The second thing they want to do is work with their allies to a greater degree, and they have a view that they will be more effective in influencing China on certain issues, not all issues, but certain issues, with the Quad and with other allies. The Trump administration picked fights with all of our allies, and the Chinese said, well, how are the Americans going to do anything vis-a-vis us if they can't even really get along with their allies and they don't have a unified view among their allies on what they want?
Bob, if they want a better relationship with China, how does this investigation into the origins of COVID-19 fit into that? This idea that President Biden is doubling down on the theory that originated from the Wuhan lab, and people are basically saying that, which could potentially really throw a kink in the relationship between the two nations, even though there aren't necessarily significant health consequences in the near term that would stem from that.
Well, the answer is I don't know. I don't know what they know and what they don't know and what their objectives are in this. So I really can't comment on that. I will look beyond that, though, and say that over a period of time, there is, in the health area and the climate area and many others, these are the two most powerful countries in the world with also a substantial amount of scientific expertise. And over a period of time, we're going to have to work with the Chinese and get through this period to deal with the pandemics of the future and deal with flu. We get a lot of information, early stage information on Asian flus from the Chinese, which helps us to develop our vaccines here because the flu tends to move from Asia to the U.S. So whatever happens now, whatever the reasons behind it, and I just don't know what they are, over the medium term, we're going to have to work with the Chinese on health issues and and numerous other issues, climate issues, financial issues. Don't forget, we were able to deal with the 2008 financial crisis in part by working very closely with the Chinese. So we have to sort of divide these things into short and medium term elements.
Bob, where does trade come into this? Because there's been a real tensioning in the relationship there with tariffs and certain agreements that China came to that they have not necessarily fulfilled when it comes to buying U.S. goods. What does the Biden administration want to see with trade between the U.S. and China?
I think what there are certainly as you recall, there were a few issues in what was called phase one, mostly China buying more stuff from the United States, agricultural products, natural gas, things of that nature. Now we're going to have to move to phase two, which is agreement on intellectual property, trade secrets, a whole range of things. And we have a very competent trade negotiator. And I think there's an understanding that at some point we have to move not to some grand new phase two deal, but identify 2 or 3 or 4 areas where we need to reach some level, if not total convergence, at least a framework for dealing with these issues. What we're doing now is we're sort of moving apart. We're becoming more self-sufficient. China's becoming more self-sufficient in certain areas like that have to deal with very highly advanced 21st century technologies. But over a period of time, we need some degree of understanding of rules to deal, the framework for dealing with some of these newer technologies, safety issues, for instance, ethical issues, a whole range of things when we deal with things like AI or quantum computing. And someone has to set international standards for these things. Yeah. And the 2 most important countries are China and the U.S. If you look at the legislation that's being produced now, a part of it is to have the U.S. be a leader in setting international standards. China wants to be. We should also be a leader, and we have to work with them on international standards for the newer technologies.
Ambassador.
Otherwise, we'll have a fragmentation of the world, and each country will have its own national standards, and that's not healthy, and it doesn't improve efficiency.
We're against the clock, but you know I love catching up with you. Bob Hormats, Tiedemann Advisors Managing Director from New York City this morning. Good morning. Equity futures up 0.4% on the S&P through 4,200 alongside Tom Keene, Lisa Brabowitz up, Jonathan Ferro up 18 on the S&P. We are positive 0.4%. Your yield higher by a couple of basis points to 161.81. For our audience worldwide, this is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. U.S. oil futures climbed to their highest in more than 2.5 years today. West Texas Intermediate rose as much as 3%. OPEC and its allies are forecasting that the global market will tighten up. The cartel says the oil glut built up during the pandemic has almost gone. France's President Emmanuel Macron demands to know if the U.S. is still spying on EU leaders. Macron was reacting to reports that American intelligence monitored Germany's Chancellor Angela Merkel and other European politicians with the help of Denmark. The Danish are amongst the U.S.'s closest allies in Europe. And there's a report that Japan will allow some spectators at next month's Summer Olympics. According to TV Asahi, organizers will let domestic fans attend the games. Spectators will be required to have a negative virus test or a vaccination certificate. Fans from overseas would not be allowed to see the Olympics in person. And the world's biggest meat supplier has become the latest casualty of a cyber security attack. JBS says it shut its North American and Australian computer networks after an organized assault on some of its servers. The JBS attack took place 3 weeks after the operator of the biggest U.S. gasoline pipeline was targeted. Instacart has a plan to replace its army of gig shoppers with robots. It's part of a long-term strategy to cut costs and put its relationship with supermarket chains on a sustainable footing. Bloomberg's reviewed documents that detail the plan. It involves building automated fulfillment centers around the U.S. where hundreds of robots would fetch boxes of cereal and cans of soup. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
It's vaccination, vaccination, vaccination. That is to find how robust the recovery is. We need a very important effort to be able to get vaccines into the arms of people in developing and emerging economies. Without that, we won't be able to say that we've overcome the crisis.
Hang on, Guri there, the OECD Secretary General from New York City this morning. Good morning, alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Can I get down to the opening bell stateside in New York? Equities up 18 points on the S&P 500. We advanced 0.4% after a slim month of gains for the month of May on the S&P 500. Coming into June, your yield is higher by 2 basis points, a little bit more than that this morning at 161.81 on 10s. FX market, euro dollar unchanged at 122.25, and crude a 68 handle now on WTI, up 2.5%, Tom, to $68 and about 1 cent.
A little misleading. On the way up, I look at Brent. On the way down, I look at West Texas Intermediate. On the way up here, $70.64 on Brent crude, more of the global price. You've got lots going on in commodities. We'll discuss that here in a moment. Right now, let us wander out to 2025 or maybe out to 2030. We do that with Amish Adalja of Johns Hopkins Center for Health Security. And what is so important here is people like Dr. Adalja wander out into the rural parts of China looking at bat research and how it links into people research and what it means for the future of COVID. Dr. Adalja, out 4 years, out 5 years, do you just assume there will be more COVIDs?
You definitely have to assume that there's going to be more COVIDs. We know that the coronavirus family has many different viruses that are circulating in bats, some of which are going to have the capacity to infect humans. So we have to be prepared for the next COVID. We have to understand how this coronavirus found its way from bats into humans in order to make us more resilient to the next coronavirus emergency. And there are whole other viral families as well that we have to continue to be vigilant about. There will be another pandemic. There will be more infectious disease emergencies. We have to be ready, and we can't have the same mistakes occur again.
Is that the warfare of university against university in terms of funding it, or do you look to larger government and NGO institutions to drive forward the research?
It's really all of the above. you have to remember that infectious disease, when it gets to the point of a pandemic, that really becomes a national security emergency. And it is incumbent upon governments to think about public health infrastructure as part of national security infrastructure and fund it that way. So right now we have a chance to get this right with the U.S. government in terms of pandemic funding, in terms of prioritization, as well as globally with NGOs that are engaged, as well as universities thinking of new research that they're getting involved in. And it even goes down to the local and state level. We have to improve public health infrastructure at that lowest level if we're going to be resilient, because that's where a lot of the failures happened, was the fact that local health departments didn't have the ability to test, they didn't have the ability to contact trace, and that really put the United States in a bad position. Now everybody sees what people have been talking about for decade after decade, the neglect of public health.
I'm really kind of shocked that Tom didn't start with Greek, the idea that alpha, beta, gamma, delta, alpha being the variant that we saw coming out of the United Kingdom, and delta is the variant coming out of India. The new names, because the old names were too confusing, B1117 or B167. The question is, going forward, are we going to get a beta? Are we going to get a gamma that's going to potentially be more virulent, that's going to puncture through some of the vaccination protections and lead to another cycle in the COVID pandemic? Dr. Adalja?
I think we might have lost him, Lisa. Dr. Amish Adalja there, Johns Hopkins Center for Health Security Senior Scholar. Well, you just put him to sleep, Lisa.
Speaking Greek.
Asking about the Greeks.
Well, this is actually really interesting. They've actually come up with names for variants at this point. These sort of giving them Greek letters to sort of designate them, because they are expecting further iterations.
You're dead on, Lisa. And what I find, John, so important here.
I agree with Lisa for the record. I just found that pretty funny.
No, I'm not.
It was funny.
You know, I'm not an expert on this, but John, I get more questions from people about the effect of these variants than any other thing that we do. Let me rephrase Dr. Adalja, Lisa's important question is the variants are front and center. What should we actually study from alpha to delta on the variants?
Well, I think that it's confusing now because we've got three different names. We've got UK variant 117 alpha. That's hard to remember, but I think people are going to use all the names. I do think what's important about the variants is to try and understand, are they more transmissible? What mutations make them more transmissible? Do they have the ability to evade immunity that you might have from natural infection? Meaning, can you get reinfected with the variant? And then lastly, are they able to evade vaccines? And what we've seen so far is none of the variants have the ability to evade vaccines, especially when it comes to what matters, preventing serious disease, hospitalization, and death. So it's important to track the variants and to keep a database of all of them. But I think that the solution to the variant remains all of our vaccines that are out there, Moderna, Pfizer, Johnson & Johnson, all work tremendously well when it comes to what matters with the variant. So that's the way that we get out of the variant problem, is to get more and more of the world's population vaccinated.
Dr. Adalja, in the meantime, this weekend, it seemed almost normal. People were walking around without masks. People were interacting, going inside. Is this appropriate? Is this the new normal, where we actually go back to the old normal?
I do think we are at that point now in the United States where the trajectory of the pandemic is such that we will be back to normal probably well before 4th of July. I think Memorial Day was a good marker. We've got over 40% of the U.S. population fully vaccinated, and that's kind of that inflection point that we saw in Israel when cases fell. And we've clearly tamed the virus, basically removed its ability to threaten hospitals, and that's the most important thing. So I think people are understandably and justifiably feeling that this is getting back to normal. We're still going to have cases. We're not going to get to COVID zero. We still want more people to be vaccinated. We want that number to be as high as possible. But I think we are on the way back to normal imminently.
Doctor, we've got to leave it there. Thank you, sir. Dr. Amish Adalja there of Johns Hopkins, the Center for Health Security, Senior Scholar. Going back to normal, Lisa, I wonder if we've forgotten how to socialise. Have you seen some of these videos coming from the likes of Southwest? The rowdiness. I mean, it's unbelievable.
Well, I've actually seen that people are struggling with small talk, but more than that, people don't have patience for it.
They're hitting flight attendants, Lisa, never mind struggling with small talk.
Hold on a second. Hitting flight attendants is just people being
They're going to ban alcohol now in coach. I think Southwest and American Airlines following. Tom, the good news for you, sir, I think they continue to serve alcohol in business, in a business cabin you're going to be okay.
Yeah, well, I don't know what to make of this, really. I mean, we've never been here, John.
People have been pushed to stay home for 12 months and they're exploding.
That's not why they're punching. That's not why they're
I think people have
punching
forgotten
anybody.
how to socialize, Lisa. They've forgotten how to interact with people.
There is an element also of desperation. I mean, the idea of 14 months of not being able to engage with the world in ways that were familiar, I think, led to substance abuse, led to depression. You see that spiking all over. You wonder if that's going to percolate out. We've seen increased crime in a number of different cities. How much is that going to continue, and how much will that come down as people relearn social norms?
Interesting to see what's happening in Florida. Governor Ron DeSantis basically threatening to fine anybody, any company that asks people to prove whether they've been vaccinated. The Washington Post this morning in an article, one Florida concert promoter thinks he has a workaround. Offer $18 tickets to anyone who's vaccinated and charge $999.99 for everyone else. Still trying to work this out in this country. Coming up next, Ed Yardeni Research President from New York City this morning. Good morning. Tom Keene.
Yeah, we're trying.
Lisa Abramowitz.
We're trying to do it as well as the British. We're just trying to keep up with the excellence. The British.
This is
Bloomberg. That's a Swiss watch pandemic.
Traffic. Okay. During the pandemic, no traffic. Okay. Where do you see the oil market in about 20 years or so? Non-existent.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
everything is in place for inflation to rise, and I think it's going to rise significantly enough to make the Fed uncomfortable.
If people expect inflation, then they're more willing to accept it.
The risk-free rate right now is manipulated by central bankers all over the world.
What the Fed's objective right now is managing expectations, and they're doing a great job with that.
We step back and we look at the Fed's goal of reacting, so they kind of want to wait it out. But market prices don't wait things out.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
The final month of Q2 from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Tuesday morning up 19 on the S&P 500, advancing 0.4%. What a couple of weeks we got coming up for you. Payrolls on Friday, the ECB next week, and the Federal Reserve decides the week after that.
Yeah, John, there's no question about it. To get out to June 16th and the Fed will be a really key part of the month. But what's fascinating for me is it starts right now, right today, with the markets. We'll get to the markets in a moment, John, but commodities and equities speak volumes.
Crude higher, Tom, rallying, looking for a tighter market later on this year. That's OPEC+. Plus. Do you think they have to respond to that in today's meeting? In the meetings we expect them to have over the next several months as well?
They got to be enjoying it. They need it. I mean, all sorts of countries within OPEC are loving $71 Brent crude as well. I don't really look too much at it other than demand's a lot hard to gauge than supply. We spend more of our time on countable supply analysis rather than the emotion of demand. And, John, what this comes down to is GDP 10%, and we're going to fall off a cliff, and we're all going to slow down in late 2021, 6 months away. You know what? That's drifted away, that conversation.
TK nailed it. We spend way too much time talking about demand and not enough time talking about supply. That's true of the commodity market, Lisa. True of the labor market as well going into Friday.
And there's a question here of how much of the disappointment that we saw in the previous jobs report really stemmed from people not going back into the workforce voluntarily, basically these frictions that we continue to see. I'm really curious to see how much those frictions ease, how long lasting that will be, because that will determine one of the key factors in longer lasting inflation, which is wage growth, and that a lot of people are looking at as their primary director.
What is actually causing the demand-supply mismatch at the moment? It depends who you ask. If you ask the businesses, they'll tell you, the majority of them, Lisa, will tell you it's the additional unemployment insurance. If you ask the people, the potential employees, they'll signal it's everything but.
Well, part of it is childcare, right? The idea that people are not back in school, that children are not back to their normal schedules. How much is that? How much are the jobs that people are not going back to less desirable because they're dealing with big crowds of people and they are still concerned about doing so because the pandemic has not yet gone away fully? John, these issues are going to be parsed out for a long time.
Tom, do you think Friday's a political report or an economic one?
Both, always is. Frankly, it always is. But, John, after what occurred 29 days ago, I'm still not over just the, and granted, there's a pandemic, and I think we've all rationalized how we went from 1 million on down in jobs. I don't have a clue what we're going to see Friday. I have no wisdom on it whatsoever.
266, a monster downside surprise when we were looking for 1 million. Tuesday morning. Equities up 19 on the S&P 500. We advanced by about 0.5% on the S&P 500. Just a nice little lift on the S&P. The Nasdaq up a third. The Russell doing okay as well. In the bond market, yields are higher by a couple of basis points to 161.81. And euro dollar unchanged here, Lisa, 122.21.
All right, we're going to get a slew of economic data today having to do with manufacturing. 10 a.m., the key number is U.S. May ISM manufacturing data coming out. I am curious about supply chains. I am curious about the input costs of the raw materials. We'll also be getting some data on the housing market, which has been red hot. The spending on new construction, how much is that being also hampered because of the increases that we've seen in some of the costs of things like lumber and also like labor. 2 p.m., the Fed's Lael Brainerd is going to be speaking at the New York Economic Club. Very interesting to see how much she starts shifting her view. Does she start reiterating Jim Bullard's points that he made in the Financial Times, as you, John, and Tom were talking about earlier today? How much will she start to say that there are specific metrics, there are specific time frames that they're looking at to determine if this is a transitory surge in inflation that we are seeing? And today, OPEC Plus is meeting to discuss output for the month of July. They are expected to reiterate that they will see output increases. But the reason why oil is surging today is because they did say that they do see a tightening in the market heading into year end because of how quickly some of the reserves have been drawn down. Any details on that could possibly be the most interesting aspect coming out of these meetings, John?
All this demand coming back online at the same time. Lisa, thank you. Front page of Barron's over the weekend, the everything shortage. Tom, the everything shortage, from chips to autos to your favourite table at 8 p.m. on a Saturday evening to people in the Labour report every single Friday. That seems to be the story of the moment.
The story of the moment is what we observed this weekend. I observed the Sikorsky was down because of the rain this weekend, John. I had to take a lift in, and it was $9 more than it's ever been. That's the reality people face right now.
Ed Yardeni joining us now, Yardeni Research President. Ed, love to do this with you. You coined the term bond vigilante decades ago, and many people have been asking the question, where are the bond vigilantes? With the yield still at 160 on 10s, where are they, Ed?
Well, I think they're actually back. You recall back in August, the bond yield was 0.52% as an all-time record low. And now we're somewhere around 1.6%. So, and much of that backup in bond yields occurred late last year and early this year. And then they went on a siesta. It's been really surprising to me that the bond yield has kind of gone nowhere fast over the past couple of months. But then again, I keep looking at the Fed data, and the Fed keeps buying notes and bonds. So I think that's the answer, is the Fed has been doing its best to keep the bond yield from going up. But I do think they're coming back. I think the siesta's over. I think we're going to see some bad inflation numbers up ahead here, just a continuation of the recent bad trend.
Ed, you own the high ground on this. We are honored to have you here on a June 1st. It comes down to George Akerlof writing late in the 60s, Mrs. Akerlof, presently the Secretary of Treasury, picking it up in the middle 80s, Olivier Blanchard with a definitive article on the wage price spiral. Weigh in here. Is that what's coming for 2022?
Well, I think anecdotally, there's just so much out there suggesting that the labor market's tight. And, you know, what matters for wages is the extent to which employers view it as a chronic problem. And I think it is a chronic problem. You folks mentioned all the possibilities of why the labor market's tight right now. But I think the most important one is demographics. We forgot to have kids along the way here. And there isn't just too many people.
Yes, we did, John.
Speak for yourself. Ed, there is a question, though, here going forward that there has been these frictions. Yes, it's one thing that we haven't had enough kids generally, collectively, and our fertility rate collectively has gone down. On the other hand, there is this idea that we had all these people in the labor market a year ago and now we don't, right? And that is something distinct. What is blocking them from coming back online? What's your answer to this mystery?
Well, I've been looking at the labor force data, and it definitely shows that seniors are retiring. A lot of baby boomers who worked past 65, and some of them are now in their 70s, and they've just decided, you know what, it's time to just retire, you know, meaning of life and all that. And then I think you made a very good point on childcare. We do have a childcare problem in the United States. We've had it for a long time. It was exacerbated by the pandemic. And I think as schools open up, as childcare facilities opened up, we are going to find people going back into the labor market. But nevertheless, there really is a shortage of workers, particularly skilled workers. And as you know, we've got almost as many, we've got more, almost as many job openings as we have unemployed people.
Let's build on that. I want to jump in. Just forgive me, Tom.
Please,
come in with this. It came from Jim Bullard, the St. Louis Fed president in the FT. And he was talking about maybe looking at a different metric. And maybe this is exactly where you wanted to go, Tom. Bullard is starting to advocate for the Fed to look at other measures of job market tightness, the unemployment to job opening ratio. Ed Yardeni, is that useful?
I think it's very useful, but it right now is indicating a lot of frictional unemployment, either a mismatch in skills or a geographic mismatch. Whatever it is, there's plenty of jobs out there. Employers are just, I mean, anecdotally, we see help wanted ads everywhere. But look, I think the good news here is employers, if they can, are going to use technology to increase productivity, and that should be an important offset in the next few years.
Ed, what is the level of inflation, just regular CPI, where you begin to see whispers of a time of a younger Yardeni? What's the jump point where we get out to a new inflation?
Well, I keep writing about the roaring 2020s as a possible scenario here where productivity would be a tremendous offset to labor costs. On the other hand, I also write about the 1970s, and that's when I was a bit younger. And I am concerned about that scenario. We're starting to see a lot of similarities. Food prices going up, energy prices going up, wages going up. However, in the 70s, productivity growth absolutely collapsed. And I think that's the big difference. But in the short term here, we clearly have not just only a base effect, but we have a demand shock effect, which has created a supply shock effect. And I think we are going to be shocked at some of the inflation news over the next few months, both on the CPI, deflator, and wage basis.
Ed, I think I speak for all of us. It has been way too long.
Yeah.
Come back soon.
Absolutely.
We're thinking Thursday, Ed.
Yeah, Denny Research President. Going into payrolls Friday, talking about the dynamics in this economy. Yields are up 2 basis points on 10s to 161, call it 162. Ed talking about the bond vigilantes making a return. Well, they're not back in Japan. The 10-year Japanese government bond today did not trade. It did not trade. No trading for the first time in a year. And Tom, it wasn't because the market was shut.
Yeah.
There just wasn't any trading.
There's no trading, and it has to do with just a bankrupt policy. I've heard a lot of people talk about this. It's just not good. You need price discovery within a system, and granted, the U.S. system, Cameron Christ has been brilliant on this. The U.S. system right now, John, is original to say the least, but at least there's movement and price discovery every day.
It is not in the JGB market right now, Lisa.
Well, how do you do price discovery when you've got a whale in the market at all times that's getting bigger? How do you deal with price discovery when central banks are discovering the price for you, John? I mean, this is the conundrum.
They are the price-insensitive buyer, and they are the whale. And I agree with you. I think, Lisa, it makes it very, very difficult. What's happened in the JGB market, though? Volume, just not there.
John,
no trading.
How big is the ISM today? I mean, help me here. I don't watch it.
Just in terms of the direction of travel and the concept of peak growth, which seems to have got everybody's attention.
It's like a big deal,
rates
right?
Of growth.
Yeah.
I think it plays into that, for sure.
I think it also gives some sort of sense with respect to supply chain disruptions. And that, I think, is a key concern with respect to the frictions of getting the economy back in line.
Prices paid, finding the right labour market, the hiring story, all beneath the surface in the ISMs we've seen over the last several months, the PMIs as well. Your yield, 161.81 on a 10-year, up around about a couple of basis points. Your equity market advancing on radio, on TV. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden will unveil plans aimed at reducing the black-white wealth gap. That will happen today in Tulsa, where the president will mark the 100th anniversary of a massacre that took place in a prosperous black neighborhood. President Biden is expected to offer proposals aimed at boosting home ownership and helping minority small businesses. China has taken its most substantial move yet to rein in the surging yuan. Beijing is forcing banks to hold more foreign currencies in reserve for the first time in more than a decade. That effectively reduces the supply of dollars and other currencies on shore, and that puts pressure on the yuan to weaken. Tension over Iran is set to rise after two confidential reports from the International Atomic Energy Agency. One says that Iran has continued to stonewall diplomats investigating decades-old traces of uranium found at undeclared sites. Another says that Iran is blocking IAEA monitors from doing their jobs. The reports were circulated as Iran and global powers negotiate reviving the 2015 nuclear agreement. Two big private equity firms are taking cloud company Cloudera private. Affiliates of KKR and Clayton, DeVilliers and Rice will value Cloudera at about $5.3 billion in the all-cash transaction. That would represent a 24% premium to the company's previous close. Cloudera's largest shareholder is activist investor Carl Icahn. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
He has expressed to me and to our group numerous times his desire to work with us and to negotiate a package. And I think that's what you see in facts that we're inching towards one another. I understand there's a deadline here. I understand at some point if we don't get there, but it won't be for trying. It won't because we didn't try.
It won't be because we didn't try. Senator Shelley Moore Capito speaking on Fox News over the weekend. From New York, this is Bloomberg alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. 7:30 Eastern, just around the corner. Before we get there, 7:18. That's just how time works. Do you like that? Making no sense this morning at all. I sound like Tom Keene. I'm up 22 points on the S&P 500. We advance a 0.5%. I've been away from him a couple of days, Lisa. This is what happens. Yields higher by a couple of basis points to 161.30.
We had a cast of thousands replace you on Friday.
How did that work out?
It was just,
Were they auditions to replace me?
I don't know. I'm not going to go there.
Could you line that up? Let me get to AMC Entertainment, as if this isn't entertaining enough. AMC up by 10.9% of the pre-market, 28.97. So doing a capital raise, guys, to Mudrick Capital, but issuing that equity at a premium to the close on Friday. And the company, the CEO saying, it's time for the company to go on the offense again. They're talking about buying up theaters, real estate. They're discussing maybe exploring deleveraging opportunities as well. The stock is positive after a capital raise, a share sale, Tom.
Yeah, and Paul Sweeney, who's really expert on this, said this is a great, great mystery for Hollywood. They really don't know how theaters are going to work.
How will they work? And Lisa, you raised this question as soon as that capital raise dropped on the Bloomberg.
Yeah.
What does this company look like?
Well, I mean, are they going to buy more theaters? Are people going to be rushing back to movie theaters when they have 14 streaming services at this point? Do they want that collective experience? Honestly, I wonder how much, and John, you raised this point, this idea of will Mudrick use this as a way to buy up distressed assets, like, for example, movie theater companies and the actual infrastructure, potentially sell it at a higher price.
AMC, a distressed asset vehicle. TK, what do you make of that?
I make of it is it's kids on couches with laptops moving around prices, and AMC's being opportunistic about it as they should. Right now, let's be opportunistic about Washington, the talk shows, including the senator from West Virginia. Well, entertaining. Our Jet Fitzpatrick is Bloomberg infrastructure reporter and joins us this morning. To me, Jack, it's really simple. It's the get it done of the Republicans versus some of the emotional infrastructure of the Democrats. Maybe it's about bridges, roads, tunnels, and the Democrats say don't take out the lead pipe funding as well. Emotionally, how far apart are these two parties?
Emotionally, they're not too far apart when Republicans are talking to President Biden. The issue that Republicans have cited over the last month or so is that they get closer and closer together and are in a very good mood on both sides in terms of finding common ground and just focusing on what they agree on. And then afterwards, the rest of the Biden administration will push for something a little more partisan that Democrats want. So if there is a meeting this week, as there is expected to be between Republicans and the president at some point, the emotions are pretty positive and the mood is good. The question is, can they actually follow through on that and actually turn this into legislative language that both sides agree on? But the mood tends to be good when there is a meeting between Republicans and President Biden.
What is the number one roadblock to split the difference? Let's go.
How much of this gets paid for with money that Biden doesn't want to use? Does it rely very, very heavily on using unspent money from the stimulus? Is this really new money? Is it $1 trillion or so in new money, or is it $1 trillion in overall spending plus or minus $700 billion that's taken away from something else? There's a pretty big delta between the two sides in terms of the amount of money they want to use, but how much of it is pulled out of something else that Republicans want to take from, like the unspent stimulus funds.
Jack, how much momentum is there behind this right now?
It seems to be slowing a little because of the impatience from Democrats. The mood can be good, but if there are enough Democrats saying these proposals from Republicans aren't serious enough and we're running out of time, then you start to lose momentum. And we could really see the momentum stop as soon as later this week if we don't see them really push through this. So I would say it's slowing down as of right now.
Meanwhile, internationally, there's quite a bit of momentum around a number of different relationships the U.S. has. We've been talking about China for the bulk of the morning. There is also a question about reinstating the Iranian nuclear accord. There was a sense that perhaps we were getting close to doing that. Where are we on that front?
Yeah, that's something that you're correct to say. There's a sense we were getting closer to that. That's an area with a lot of partisan disagreement right now in Washington, and I'm not sure I necessarily have a concrete update on what comes next, but it is something that seemed to be an issue that the Biden administration was at least inching forward on, but I don't know if we're going to see news on that in the very, very near future.
Jet Fitzpatrick, does West Virginia get an airport that'll rival Dubai?
Depending on how they work out the earmark system, this has been a joke. I know a lot of people have told that West Virginia is going to look like the city of the future by the time they're done with Joe Manchin's earmarks. There are going to be some limits on exactly how much they can do for 1 or 2 members, but West Virginia is really in a key position here with Shelley-Moore Capital leading the talks and Joe Manchin backing her up and insisting on bipartisan talks. So it's probably going to look pretty good for West Virginia.
Jack Fitzpatrick of Bloomberg Government down in D.C. Tom Keene, you're on form this morning. Kids on laptops moving around stocks, Dubai Airport International in West Virginia. Which one do you want to start with?
I don't know. I survived the weekend.
You got through it?
Yeah, I got through the weekend.
Let's talk about the kids moving around stocks on laptops.
It's a good point.
Look, you're talking about AMC.
They're making more.
Okay, but is it still what you just alluded to? Is it something much more than that now?
No,
and I would argue if the likes of Mudrick Capital are getting given the way they are, I'd say yes.
Look, the kids wake up and they're looking at Bitcoin and then they're trying to get a Doge quote and they're upset they can't get it off the Bloomberg. We don't have it because it's not real. 36,000 on BitDog.
Wait, hold on a second. Tom, you actually have a point, though. And I will say this, John, that the idea that Mudrick wants to get involved when the shares are valued as highly as they are gives them the ability to raise more money, to sell them at potentially a higher price and then use the cash to do other things. There is a lot of ways for them to play a company that is in the popular eye because of kids moving around stocks on their laptops.
I mean, we're talking about the equity, we're not talking about the credit. Have you seen the trip the credit market's been on?
Yeah.
AMC debt. I mean, some of the debt that was issued back in 2017 dropped to as low as, I think, below 10, and now it's back to 75, and some of those maturities are higher than that for various reasons, of course, and I won't get into the dynamics of the credit market. The cheat guide to this, Lisa, is we collapsed. We were talking about bankruptcy.
Yeah.
And then we ripped back.
Yeah, and there's a question of whether they are proven yet to be a comeback story because people are not really going back to the movie theaters yet in force. And what is that business model, as you both have been talking about?
Are they going to go back?
But are the masses going to go back in the same kind of way? Frozen sing-along. John Farrow wants to do that this weekend.
Kids are captivated by that, aren't they?
Can you
nephew
imagine?
can't get away from it. Just stares at it, hypnotized.
Tom,
what
can you
is it
imagine?
about that movie?
John at a sing-along of
Frozen.
any sort?
No.
Tom would go.
Tom's had enough kids for me, so I'm just going to average it out.
No, John, my highest recommendation.
This is Bloomberg.
generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
From New York City for our audience worldwide, good morning. Tuesday morning, price action like this, up 23 on the S&P, advancing 0.6%. On the Nasdaq, up 0.4%. On the Russell, your outperformance on the small caps this morning, up 0.9%. All-time highs in Europe on this side of the Atlantic, not too far behind. Switch up the board, get to the bond market. Remarkable stability in the bond market. We have not traded in Japan on the 10-year in today's session for the first time in about a year. I guess the real headline is, it's not the first time we've seen that happen. We've seen it a few times over in the JGB market. The 10-year nominal yield has also been a snooze. When we topped out at the end of March on a closing basis at 174, we've talked about this repeatedly on this program, we're back to 160, 130, and that is basically your average over the last couple of months. Many people believe, though, that because of the amount of debt the Treasury's got to issue, that one of two things has got to happen. Either yields are going to go higher, or the dollar's got to get weaker. Well, right now, your nominal yield's not doing much, so does the dollar have to get weaker, and against what? Finish on this. Dollar China over the last year with a big move lower into the Chinese currency's favor, a move of more than 10%. And then the Chinese come out with more than just a verbal pushback, some real policy, asking the banks to hold more in foreign exchange reserves. Looking to put the brakes on this one, TK, with dollar China down to about 638. But if you need to see a weaker dollar to fund that deficit, who's going to absorb the stronger currency? The Chinese don't want it. They've taken it so far. Will the Europeans take it? Will Japan?
Well, the answer is no, and the answer is there's always a race to the bottom, a race to weakness on the currency markets. It's out there, it's a fact, but I would suggest, John, what we've seen in the ending weeks of May is a Pacific Rim strength that has been really noted, led by renminbi, but really other currencies, ex-Japan as well. You know, John, it does redound back over to the equity markets.
Yep, and equity futures this morning are positive. Even with this story just playing out in the background, I think it's the one to watch. 638 on dollar China. Let's get you some movers and say good morning to Romain. Morning, Romain.
Hey, good morning, guys. Yeah, the S&P is moving a little bit higher here. Volume, though, is still relatively light here. When you look at the top of the leaderboard, not only in terms of what's moving, but also in terms of the actual volume and value, it's a lot of energy stocks at the top of the board, like Devon Energy, Occidental as well. Devon Energy up about 3% here. You've got this day here where you've got crude oil here, WTI crude, well back above that $68 level. And, of course, over there in London, you got Brent crude camped out above 70. These are back at those 2018, 2019 levels here. Of course, waiting on word out of that OPEC Plus meeting. That could be another potential catalyst here, up or down for some of these names. A big deal here for Cloudera. Not a huge deal. $5 billion here as far as the actual valuation. KKR taking this company private. Remember, Cloudera was supposed to be the big open source challenger to a lot of these cloud companies like the Microsofts, Amazons, Googles, et cetera, except they just really weren't able to sort of trade punches with them. So they're going private. Those shares up 24% here pre-market. And AMC getting another bid here. Had a private equity offering here that priced about $1 above where it closed on Friday. Those shares higher by about 11%. Company says it's going to use those proceeds for acquisitions and to deleverage. You flip up the board, take a look at a few other quick names. A downgrade here for Lumentum, some concerns here about its relationship with Apple. An upgrade here for Affirm Holdings. The company saying that it's, the analyst saying that its partnership with Shopify as well as with Peloton, that's actually going to be a big beneficiary here. And keep an eye on the EV stocks. You got some data out of NIO and XPeng over the weekend. This is the Chinese car automakers. NIO's sales were up about 100% here, year over year.
Yeah, over the weekend, some buzz there on Affirm and Klarna and the rest of it as well. Romain Bostic, thank you so much. Greatly appreciate it. How do we on a June morning synthesize what we're seeing, the dynamics, the Newtonian plumbing, if you will, of the financial system? Well, it always redounds back to the dollar. Let's take the conversation that we just had with the giant Edward Yardeni about inflation, and maybe it's cost push, maybe it's demand pull. Zachary Griffith has to synthesize this for Wells Fargo. Zachary Griffith, how do you get from inflation guesstimates to yield guesstimates over to the dollar?
Hey, Tom, thanks for having me. Yeah, so that's really the big question. And for us, we see inflation rising, and that should push yields higher, and that's, you know, part of the story that really comes down to the global reopening. We have a very tolerant Fed with higher yields and very heavy supply, as you outlined earlier. As far as the dollar goes, we think that dollar weakness is what we're going to see for the next month or two. And again, that comes down to a Fed that's really been the most resolutely dovish of the major central banks. And at the same time, you have this U.S. exceptionalism story fading, where other major economies are picking up from both a public health and economic perspective. So that's kind of how we see things unfolding over the next month or two.
As a rates guy, what dollar pair or dollar index do you use as your litmus paper for the American system?
We really keep an eye on the DXY and certainly seen that come off quite a bit. And we've been in the camp that we should see dollar weakness for about a month now. We think that that could last another month or two as the factors that I just outlined really play out over that time frame. And then just with respect to our target for the 10-year Treasury yield, we think that that's going to continue rising again toward the middle of the year and could hit 1.85% by the end of this month. So that's a target that we took down a bit. We were a little bit more aggressive, but it seems like this recent range has been pretty sticky. So we kind of had to reset our expectations, and that's where we see things going over the next month.
Zach offered a very basic framework outline that many people are pushing to think about the Treasury market at the moment. To fund this deficit, we either need higher yields or a weaker dollar. Is it as simple as that, Zach?
Well, from the higher yield perspective, we think so, and that really just comes down to the supply-demand dynamics. And you really saw some of that play out in the first quarter, specifically in February. You had a couple auctions. The 7-year auction had some of the worst stats we've seen in a while. So we think that you've seen some episodes of duration indigestion, and that's sort of faded a bit. I'd say the auctions last week went fairly well, but this supply story is kind of a longer-term one that we expect to play out gradually, and that's what's really going to push yields higher is you need to get paid more to take down all this debt.
Well, just how tight is the relationship between the deficit and Treasury yields historically, Zach? How tight is it?
It's been a strong one recently, and I guess it's been stronger from the analysis that we've done with respect to the shape of the curve. You really see the back end steepen when deficits are rising, and we've certainly seen a huge increase in deficits over the past year. The issuance patterns have been a bit different, with bills really doing most of the heavy lifting last year, and we're shifting that out to coupon debt as we really term out the debt that was used to finance the CARES Act and other bills initially. So we think that terming out all of this duration, again, it's going to come down to yields need to rise for market participants to be willing to take all of it down.
Zach, we've gotten a lot less certain about the likelihood of an infrastructure package getting passed, and the size of that infrastructure package has come down as time has gone on. Has that already been priced into market? I mean, could there be, for example, surprising dollar strength if there isn't some massive infrastructure plan that is passed that increases the deficit to the degree that people expected?
That's a great question. I think that expectations have come down quite a bit, and you've had the two packages out there totaling nearly $4 trillion, and we've been in the camp that we could get another deal by, call it September of this year, maybe a bit later, but it's going to be much smaller than the two that were originally outlined. And I think expectations have come down and are more in line with what we had been originally thinking. And again, it's going to come down to Congress has had a tough time getting around this another package when you have economic growth coming up so much. You have deficits so high already. But when it comes down to the economic impact of these different packages, it's going to be much longer term than the COVID relief we've seen. So as far as the market reaction, we think it's going to be much less severe than what we saw when we were throwing around COVID relief deals that were very deficit financed, and the spending was very immediate in most cases.
How high can U.S. yields actually go at this point based on the foreign flows that we've been seeing into the United States from countries like Japan, which we've been talking about, and Europe, which have incredibly low, indeed negative yields?
Yeah, that's a great point, and we think that's a big reason why yields will rise, but not tremendously so. When you look at U.S. Treasury yields on an FX-adjusted basis, they're extremely attractive for both Japanese and European buyers that hedge at least some of the currency risk. So we think that's definitely a factor that puts a ceiling on how high yields can go. But with a very tolerant Fed, and that was something that we did not expect to see when rates began to rise in the first quarter, the rhetoric around that out of Fed policymakers was very receptive. And I think my favorite quote was from Chairman Powell calling it a vote of confidence in the U.S. economic recovery. So I think that with the Fed more comfortable, it takes the ceiling a bit higher. But again, the foreign dynamics and the buying that we've seen definitely puts something of a soft ceiling on how high we can go.
Zach, got to leave it there. Thank you, sir. Zachary Griffiths there, Wells Fargo senior macro strategist. Not just a tolerance, but it was almost an endorsement from some Fed officials earlier on this year when yields started to rise, and they said it was consistent with the brighter outlook. What surprised me, Tom, was to hear that from an ECB official. Executive board member Isabel Schnabel, I believe, speaking to Reuters recently, and this was the quote: most importantly, recent yield developments were more clearly related to an improvement in the Eurozone growth outlook rather than foreign spillovers. This is precisely what we would expect and what we want to see. I, for one, was surprised to hear it from an ECB executive board member.
Well, you're going to see it through Euro 123, and we're not there yet. You can get there very quickly. We can go there in 1 or 2 days as well. John, I would do the correlation here of June is busting out all over, and maybe my headline for today is commodities are busting out all over, affecting Europe as well. The Bloomberg Commodity Index up 20% year to date. From the bottoms, it's up 56% roughly from the pandemic lows. And even from where we were before the pandemic, John, commodities are up a robust 16%. There's something going on here more than pandemic analysis.
And the threat of a weaker Chinese currency is doing nothing to dent the appetite of this rally this morning, Lisa.
Yeah, and there is also a question about how much of the increase in prices has been transitory due to some of the supply chain kinks, due to the fact that we've had cargo ships that have been stranded on the seas due to the pandemic, and how much is due to a new regime where we're building more stuff, we're buying more stuff, we are having bigger footprints, and thus the price of stuff.
And it's the US driving this cycle and not China. It's a real change from what we saw coming out of the last crisis. Tom, you still playing that drinking game? I've got you in the corner of my eye. You hear transitory and drink.
Yeah, well, we went to more of a summer thing with Tang Mimosas, and it's working out.
Tang Mimosas.
Yeah, it's working out
Nice.
great. I mean,
it sounds really good. Enjoy.
Do you force your kids to eat Tang?
Actually, no. Well, it's not champagne. It's cold duck, but that's.
What's it called?
Cold duck, John.
Coming up,
John.
Janine Way,
Cold duck.
Barclays senior
a beverage from
analyst.
years ago.
You can tell me more about it in a minute.
It's back.
Up 22 on the S&P.
Crosby, Stills, Nash and Young, Deja
up a
Vu.
half of 1% to 42.24.
1970.
I hope you all enjoyed.
Cold duck. Would you like to listen
the last couple of days? Welcome back from New York. This is Bloomberg.
With the first word news, I'm Rishka Gupta. U.S. oil futures climbed to their highest in more than 2.5 years today. West Texas Intermediate rose as much as 3%. OPEC and its allies are forecasting that the global market will tighten up. The cartel says the oil glut built up during the pandemic has almost gone. And higher energy prices are one of the reasons inflation in the euro area climbed to the highest level in more than 2 years. Consumer prices rose an annual 2% in May, more than economists had predicted. A separate report said that factories lifted their prices by the most in more than 18 years. And there's a report that Japan will allow some spectators at next month's Summer Olympics. According to TV Asahi, organizers will let domestic fans attend the games. Spectators will be required to provide a negative virus test or a vaccination certificate. Fans from overseas would not be allowed to see the Olympics in person. In tennis, women's star Naomi Osaka has dropped out of the French Open because of a dispute over mandatory press conferences. Osaka said in a social media post that she suffered from depression and social anxiety disorder. She says that taking part in press conferences makes matters worse. Osaka is ranked second in the world. And Krispy Kreme is set to become a public company for the second time. The American donut shop chain publicly filed for an IPO on the NASDAQ. JAB bought Krispy Kreme for more than $1.3 billion in 2016. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
The power of Bloomberg. First on news.
Headlines crossing from Morgan Stanley to management shakeup, planning for transition in 3 years potentially.
This is a huge move over at JP Morgan. It is a shock, of course, to the market.
First on earnings.
Apple, a big beat, well ahead of the 33% increase in revenue.
First on markets.
The capitulation phase is by.
The power of the Bloomberg terminal. The power of Bloomberg television and radio. Bloomberg has it covered.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Friday is Jobs Day on Bloomberg Television. After April payroll numbers hit below estimates, investors look for a rebound in the labor market. The May Jobs Report, Friday morning on Bloomberg Television and Radio.
Boeing has delayed the deliveries until 2023, and we are fine. If they can deliver it to us in 2022, we will accept them. The only problem we have is there is a stress in the supply chain for the entire aviation industry, and I hope that that will be resolved.
Pick a sector. We've heard that last line on repeat. That was the Qatar Airways Group CEO speaking to Bloomberg from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Here's the equity market as we kick off the month of June. Up 22 on the S&P. We advance 0.5%. 161.64. Yields are higher by a couple of basis points. You could clip and repeat that line too. Euro dollar 122.19. We're down 0.1%. Just a slightly weaker euro here, Tom. Crude 68 handle.
Very quick.
WTI 68.25.
John, very quickly here at 4224, Standard & Poor's 500. Remember how absurd not that long ago 4,200 or 4,500 felt?
Ridiculous.
On Standard & Poor's.
When people were putting together those year-end forecasts on the S&P 500, back end of October, early November, developing the year-ahead outlook, then the headline dropped around some of the efficacy for Moderna, for Pfizer, changed the game. What surprised people, I think, is not the cyclical rally. It's just how well tech actually held up. That tech didn't collapse and fall away, which would really weigh on the index in a massive way. The tech held up and everything else had a rip.
And John Stolfus very strong on the idea of tech having a better back end of 2021. Dow up 36%, SPX up 38%, NASDAQ Composite up 45% here, 12 months trailing. Dave Wilson has these numbers tattooed on his left arm. He also knows it's about the fundamentals of earnings, I should say, rather. And you've got an earnings update here is 512 with the S&P 500 reported.
Well, actually, our number, as it turns out, is 489. We don't necessarily get 500, it seems, every quarter, so we have about 10 left to report. But what's really striking is you're looking at a third straight quarter where companies way ahead of analyst estimates when you look at earnings, and yet getting no reward for it. In this particular case, if you look at the first quarter numbers, on average, shares moving the day after reporting, when companies are beating estimates for the first quarter, they rose less than 0.1%.
But we're up 38%, 12 months trailing. And once again, the market gets out front with the expectation.
Oh, yeah. I mean, that's definitely part of the mix here. And it's also the anticipation, perhaps, that what we see looking forward is not as promising, perhaps, as what we see looking back at these quarterly results, comparing them with estimates. One thing you can say, though, is that really quarterly results have become a one-way street for companies in the sense that, you know, if you come up short of projections, your shares still fall. On average, you look at the S&P 500, down 2.2% the day after reporting results when the earnings came up short. And that's in keeping with what we've seen now for several quarters. So, you know, that's consistent. But, you know, in terms of beating projections, the last 3 quarters, companies haven't gotten any benefit. In fact, for the fourth quarter results last year, they actually fell on average in response to results. So it just shows you how things have gotten arguably out of whack. You know, you're talking about how much stocks are up in the last 12 months. That's part of it. Clearly, the effect of the pandemic on earnings and on estimates is part of it. So when you put it all together, it's clear that, you know, there's not a whole lot companies can gain at this point by coming out ahead of projections.
Well, but Dave,
it really is an issue of what happens when they come up short.
Is out of whack really the takeaway here, or is it that it is priced in, that people have already priced in such an optimistic future and brought forward the future to now when it comes to the pricing, that it requires some massive, massive shift in the business model to a more optimistic trajectory in order to get stock investors excited?
You're onto something, Lisa, no question. And it's about the forecast. In a lot of cases, you know, companies talking about how numbers may come up short for their current quarter or their year, you know, or finding some issue in terms of, you know, their profitability, you know, especially when you look at the, you know, higher costs of labor, of transportation, those sort of issues. So it really is a matter of kind of looking ahead and perhaps not seeing quite the optimism that's already built into share prices, no question, but is also built into these quarterly results when you compare them with estimates.
David Wilson, thank you so much. Greatly appreciated this morning. You know, the Deutsche Bank story, John, that just came out here on work from home, I mean, it really talks to where we are in June. And, you know, to be honest, to me, it's a mystery to get to Labor Day and certainly into 2022. Every company has a different formula.
They're going to inform staff on work from home rules, Tom, in due course.
Due course.
They've had 12 months to work out that, unveiling this hybrid model for post-pandemic work.
I'm thinking...
Haven't we been doing that?
Didn't we get due course? It was an email, single sentence.
Yeah.
Somewhere coursing back to November of last year.
Maybe April, May of last year. Lisa, you identified the difference as well, the transatlantic difference between how the European banks are playing this and how they're playing it on Wall Street.
Yeah, in Europe, they're basically saying, great, work from home, we'll cut our footprints, we'll reduce costs. In the U.S., they're saying, get back to the office. There's an office culture. There is more productivity in the office. What I find interesting is from an investment standpoint, offices have come back much more when it comes to valuations than, say, brick and mortar retail. And this, to me, is a real question. Why should that be? In other words, if offices are going to be subject to the same dynamic as malls, why shouldn't they be as devalued as you're seeing mall real estate?
What does this hybrid model actually look like? Do you skip Mondays and Fridays, Tom? Is this how this plays out? Does everyone want the Monday off, the Friday off? Does everyone work the same days in the office? Do they rotate?
I go back to Marissa Mayer at Yahoo. Over 10 years ago, they did a study. She said, let's actually learn about this. And she was heated. Work from home doesn't matter. Heated.
Lisa?
I think that there is a bias, though, in terms of who chooses to work from home. I mean, there are a number of studies that show that people who work from home don't get promoted as frequently, but often people stay home because they have children to take care of, or they're in a situation where they need to take care of things at home, so they can't work as much. There's also the question of office culture. People want to be with one another, especially if they're younger and they don't have families and other obligations.
I don't agree with that at all. If you have family and kids, you want to be in the office more.
Sure. It's the question of whether you can. Do you want to talk about your weekend, Tom?
I think Tom wants to talk about a range of things this morning. The other thing is hitting the road and making a sale. Making a sale.
Yeah.
We've been discussing that a million times, haven't we? If you're willing to get out and see a client face to face, Lisa, surely that gives you the edge.
And you're seeing business travel pick up again. My question is there going to be internal company travel that won't necessarily happen, right? I mean, is that the marginal business travel that's not going to come back? And the rest of it we're going to see come back because you're already seeing that happen.
You're not going to go to the local restaurant, Sincumbaya team meeting that nobody really wants to be a part of.
Small
team
talk.
outing that nobody really wants to go on.
You know what I've seen from all my friends? None of them have patience for the small talk or the relationships on the periphery that they didn't necessarily want to begin with.
That doesn't surprise me that your friend group doesn't have patience for small talk at all. Just knowing you, Lisa. I think we should move on from this. Brent Shooter is going to help us do that a little bit later from Northwestern, the mutual chief investment strategist. We're looking forward to that conversation.
We are.
Before we get there, equities up 22 on the S&P, 42.24, up a 0.5%. I've always said the commercial breaks of this program would be a million times better than the show itself. Yields up a couple of basis points on a 10-year to 161.47. Euro dollar unchanged at 1 and all the twos, 122.22. Run change there on crude, 68.32 on WTI, up a little more than 3%. On radio, on TV, this is Bloomberg Surveillance.
closures and the complexities of COVID, it became apparent that if we could provide this course in South Australia, it would benefit trainees of anaesthesia in the state.
Feel like I've got some excellent skills to take away from the course, and I'm very grateful that it could be run in Adelaide.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
everything is in place for inflation to rise, and I think it's going to rise significantly enough to make the Fed uncomfortable.
If people expect inflation, then they're more willing to accept it.
The risk-free rate right now is manipulated by central bankers all over the world.
What the Fed's objective right now is managing expectations, and they're doing a great job with that.
We step back and we look at the Fed's goal of reacting, so they kind of want to wait it out. But market prices don't wait things out.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television, a simulcast on a most interesting start to June. And I'm going to go to Broadway, John. Commodities, they are busting out all over.
Thanks for that, Tom. We're up more than 2% on Brent, on WTI up by about 3%. 68 handle on WTI crude, Tom. Brent with a 70 handle approaching 71. OPEC Plus talking up a tight market, tight labor market, may be the words of the St. Louis Fed President Jim Bullard. And that seems to be the theme. Pick a sector, pick a commodity, pick an asset class, pick a dynamic, Tom. It will speak to the same thing.
Well, the dynamics here are real. They're really correlated. We'll get to the data here in a moment, John, but a 71 print near 5 a.m. this morning on Brent crude speaks volumes. And I know there's an OPEC story to it, John. My only question is, talking to our guests, when do we blink and when do yields, a 10-year yield, actually move and catch up with the other dynamics we see?
So far over the last couple of months, they have not. 161, 162 is the average. That is exactly precisely where we are again this morning. In the face of a conversation about budget deficits north of $1 trillion forever in America, yields 161, 162 on a 10-year maturity.
Suits and ties, Lisa, can rationalize inflation for the people of America. It's tangible, isn't it?
Well, University of Michigan sentiment survey that came out on Friday was one of the most underplayed surveys out there. It showed that people have the expectation for 5 to 10 years of 3% inflation. Not necessarily runaway dynamics that we saw in the 1970s, but still justify a 1.61, a 1.62% 10-year yield with the expectation of 3% inflation over the next 5 to 10 years, Tom.
And John, the dynamic here on real yields, I mean, let's be honest, folks. Most of our guests are focused on the real yield. You could see that in a 4-day work week. Friday, we're looking for that Friday afternoon. But seriously, John, we just simply haven't seen the real yield coming in without inflation pushing down.
Where are we? Negative 85? Negative 86 on 10s. I agree with you, Tom. We haven't had the lift that many people expected. We haven't seen that in real yields. We had inflation expectations reprice. But even that story started to stall a little bit more recently, Tom. Even that's come in just a little bit more as well. So what's the catalyst to really change this? When is the transitory debate get addressed, get solved, get reconciled? You could be talking about the end of the year.
Well, the other
could be a long time.
The other parts of the market are getting out in front of that. Let's go through the data, John, and sit on it for a while. I'm going to do foreign exchange right now. Weaker dollar, but DXY, the blended broad index, not breaking through to new weakness. Renminbi with some yuan strength, and then over the Memorial Day weekend, sets of action by the Chinese, including that stunning 3 children policy, a weaker yuan. John, what I would notice is just one proxy is Mexican peso nicely comes in, stronger peso off oil down to 19.88.
Weaker dollar theme in spots in the FX market, well euro dollar 122.26 unchanged. In the bond market, there it is for you, up a couple of basis points, back through 160, 161.81. Equities on a nominal yield, totally stable. Your equity market with a lift up 0.6% on the S&P.
Yeah, but it's the way it's up, John. I mean, look at the Russell up 0.9%, leading the way this morning. The VIX, I'm finally getting the VIX to come in. I'm not to a 16 handle. Can you imagine a 15 handle?
Yes, Tom. I can imagine a 15 handle if this continues. I can envision what 15 would look like.
Can I throw another data point out there?
Please
and
do.
This really does have to do with the incredible environment for borrowing. Borrowing costs for investment-grade companies are now the lowest they have been post-crisis. They continue to grind tighter, now just 84 basis points. And it raises a question of what kind of risk we're building up here. The idea of what kind of buffer do you have if there is finally a move in Treasury yields, or do people not care because, frankly, they need income, they want income, we're getting older, we need that retirement, and that I think is really going to be a key dynamic.
You two sit on this for a minute because it's really important. Am I right, John, that what she just said is lesser quality bonds are less than 1% difference in yield?
Lisa was talking about investment grade, I think, Tom.
Credit?
Lisa was talking about investment grade.
Well, for a guy like me, that's lesser quality.
Well, yeah,
compared to Treasury, sure, but compared to high yield. No, I just wanted to be really clear that we weren't talking about high yield, we were talking about IG. We've had a ton of supply to match some of this as well, particularly in high yield. I think junk was a record for the previous month, the month before that, at least the month before that.
Well, and the reason why is because energy companies were actually the main ones that were driving the most recent borrowings there, because borrowing costs have gotten so cheap and energy costs have gone up. The question is, again, what are we building up? We have companies that are leveraging themselves up to the old economy in a regime of low rates that may not stick around. Yes, this is the big debate.
Careful, Lisa, with that word. Sorry to interrupt. Forgive me. Just careful with that word leverage, because a lot of this issuance this year has been refinancing, not additional leverage.
Well, refinancing, though, from 2020. Right, refinancing from the amount of cushions that people, that companies tried to get to survive the pandemic. The question now is, are they going to grow into this debt that they incurred to survive a public health crisis, right? Yep. And so, yes, they are more leveraged than they were pre-pandemic, although perhaps they're not increasing leverage at the same pace this year.
It's a very good point.
I'm confused. Joining us now, Brent Schutte, Northwestern Mutual Wealth Management. What's so important here, folks, is you have to recalibrate, not mid-year, but maybe June 1st will be a good point to do that. Brent, I want to go into the depth of your note, where one of the great opportunities here from Milwaukee to the Pacific Rim is to buy up emerging markets. So much of our radio and TV audience is behind. Is EM the place to catch up?
Well, I think international in general is a place to catch up. And so if you think about it, we've had this broadening recovery in the U.S. in the back of vaccinations, stimulus, and reopening. And now you're seeing that push into places like the Eurozone, where they're now having increased vaccinations. Their manufacturing segment is doing very well, and soon their services segment will be doing very well. And so you're going to have reopenings occur in the Eurozone. And I guess more in general, I think as we continue to think about the next part of the recovery, it is more based in the international part of the world, where they're just a bit behind the U.S.
Whereabouts, Brent? Because Europe right now is trading at all-time highs on a stock 600. What's been lagging? What hasn't participated?
Well, I mean, I think if you look past the last year or so, I think Europe in general has lagged, and that's because their economy has lagged. And they're now starting to do stimulus. They weren't doing that before, certainly. They're sharing debt more so. And so I think you're going to see a European economy that pushes forward at a rapid pace. And I think that's going to draw more investors in, because if you think about the past 13 years, and you guys have mentioned this with the Treasury trade and everything else, investors have learned not to invest overseas. And they're still extremely reluctant to move anywhere outside the U.S., especially growth. And now you're going to see that narrative change a bit. And every economic expansion is different, which means every market expansion is different. And I think this one's going to incredibly push more towards those international economies in the coming quarters.
What's the main factor, Brent, that you look at to determine which economy is further along in this cycle? Is it vaccinations? Is it the central bank and the tightening cycle? There are a lot of different competing factors here.
I think all the above, but even just take you back recently. I mean, the U.S. in the first quarter posted, 6.4% growth, I believe. The Eurozone posted negative. And so if you look at their output gap, for example, which I think is a summation of all those, their output gap is bigger than the U.S. Leading economic indicators in the Eurozone are actually down, not up like they are in the U.S. And that will actually occur. And I think this cycle's been a little bit easier because it is more along the line of COVID cases and shutdowns. Now you're going to see that starting to reopen. And I suppose I could add one more for you for those people who want to do so. Look at the Oxford stringency indexes that show how much government regulation or tightening there is based upon COVID closures. And those will actually start coming off the boil a bit in the Eurozone, and that should actually have the same impact it did in Q1 in the U.S.
Right. Brent, do we need to make bet here? I mean, in speaking with Northwestern Mutual and a more conservative idea, do we need to make bets here and strategic guesstimates out 2 years or 5 years, or do we risk an over-diversified portfolio where we've got too many ideas at play at once?
Well, certainly we look at the next 12 to 18 months heavily and how we make our tilts and our shifts of our money. I think all the things that you guys mentioned in the opening commentary between you, Lisa, and Jonathan are all out there. I think they're out there 2+ years. And so you do have this period of time, I think, right now where the markets are probably going to slow down. I don't think that's a big comment based upon the pace that they're at. But certainly I think this could be a very quick cycle, and we'll see what that actually causes. And some of that debt that's building up, the question of inflation is going to be incredibly huge. I think it's temporary right now, so I'm more consensus. I think it pulls back, but then I think it's more of a 2022 issue. And I think that is actually an issue of this expansion, because monetary and fiscal policy have adjusted to all those demographic headwinds that everyone talks about and you're actually having societal shifts towards actually inflation preferences. And so I think that's more of the next 2 to 5 years that you mentioned, where those concerns are going to be much more prevalent. I think right now you still have some time left.
Brent, just quickly, when you say a quick cycle, quicker than what we saw before in the previous cycle, which is probably easy to say relatively speaking, quick, what does that mean?
So we're still probably early cycle. We could be mid-cycle to late cycle in the next year or so. Think about the jobs market and the recovery we're likely to have there. You're going to see big job gains, and you could be at full employment in the next year. That is incredibly quick.
Brent Schutte, Northwestern Mutual Wealth Management Chief Investment Strategist. Really important point, Tom, and that's the theme that Morgan Stanley's been getting its hands around for the last couple of weeks, couple of months. This idea that it's early cycle timing, late cycle valuations. Well, that's a difficult tension to resolve.
The timing here is simple. There's a lot of people that have rationalized not participating. And the fact is, the people who are winning. There was some zeitgeist on this over the weekend. If you're not in this market, you've missed a boat. And you see it again this morning. I mean, John, the character of the equity bid here, it's a solid bid on this first day of June.
Small caps outperforming on the Russell, the S&P up by 0.5%, Lisa, the NASDAQ up 0.4.
How do you have conviction when we have the incredible swings that we've seen in the surprise index? The idea that it's been so hard to pinpoint the reasons behind the frictions that we're seeing. How do we determine where we are in the cycle? The disagreement there, it just is such a hard time to have any conviction with respect to any of these calls, because this is a unique moment in economic history.
And that was the conditioning of the last 12 months. Have conviction about nothing. Just try to stay humble about the moment we're in. Kathy Jones at Charles Schwab suggesting, and I'll catch up with Kathy a little bit later this morning.
Oh, you will?
It might be until August, September when you see the big jobs gains.
Yeah.
You've got to wait for the back to school, Tom.
Well, yeah, the back to school, I mean, you can see it in the trees. You can smell it in the breeze. June is busted out.
You've got more time here. Got another 10 seconds if you want.
Commodities are up.
Keep going.
To the moon.
No.
Beautiful.
Oh, boy.
42.25 on the S&P. Tom's here all week. This is Bloomberg.
Busting out all over.
With the first word news, I'm Rishika Gupta. President Biden will unveil plans aimed at reducing the black-white wealth gap. That will happen today in Tulsa, where the president will mark the 100th anniversary of a massacre that took place in a prosperous black neighborhood. President Biden is expected to offer proposals aimed at boosting home ownership and helping minority small businesses. China's taken its most substantial move yet to rein in the surging yuan. Beijing is forcing banks to hold more foreign currencies in reserve for the first time in more than a decade. That effectively reduces the supply of dollars and other currencies on shore, and that puts pressure on the yuan to weaken. Two confidential reports from the IAEA raise questions about whether Iran is being transparent about its nuclear activities. Next week, those reports could lead to a formal censure from the agency's board of governors. At the same time, Iran says it hopes the 2015 nuclear deal can be revived by August, when President Hassan Rouhani's administration ends. Rouhani is expected to be succeeded by a hardliner who will be more hostile to the deal and the U.S. Two big private equity firms are taking cloud company Cloudera private. Affiliates of KKR and Clayton, DeBillier and Rice will value Cloudera at about $5.3 billion in the all-cash transaction. That would represent a 24% premium to the company's previous close. Cloudera's largest shareholder is activist investor Carl Icahn. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
There is a strong recovery of oil demand, United States, China, Europe, and elsewhere. And if the oil producers, OPEC Plus, stick to their current policies, we may see a widening gap between supply and demand.
It's the theme of the moment, isn't it? That was Fanny B-Roll there, the IEA Executive Director, talking about the crude market from New York City this morning. Good morning. Alongside Tom Keane, Lisa Brambitz, I'm Jonathan Ferro. Up 22 on the S&P, we advanced 0.5%, and there's the move on crude. 68 on WTI. And just for you, Tom, perfect timing, 71 handle on Brent. $71.04, up 2.5%.
Moving up off of the 5 a.m. number this morning. Let's get right to it. This conversation is too important. Janine Way is chemical engineering out of Berkeley and has put together a storied career in the sell side of integrated oil, actually looking at the American oil companies. Janine, I got a whole bunch of ways to go here, including the climate change uproar at Exxon, but I do have to focus at $70 a barrel on the responsiveness and dynamics of oil price to say ExxonMobil's free cash flow. Is Exxon a real oil company now, or are they a bank that happens to run oil? Which is it, and what are they going to do at $70 a barrel?
Thanks for having me on, Tom. That's a very interesting question. We do think they are a real company. At $70 a barrel, there are a lot of options, but I think that the main drivers of major stock performance recently has been twofold: dividend sanctity and timing of cash returns to shareholders. And so at $70, we think that it's a matter of when and not if that Exxon starts returning incremental cash to shareholders. And we think that could probably happen in 2022 because that's when they get within the range of their debt reduction targets.
Their 10-year per year return is a travesty. Their 20-year, 10-year return is how CEOs get fired. What's the new religion at ExxonMobil?
Well, the new religion is that there's been a paradigm shift in energy broadly, I would say. There's a focus on go-forward cash returns, and there's a significant high grading at Exxon for the projects going forward, which should exactly change the track record of the poor ROCE going forward. So there's a paradigm change in energy, focus on free cash flow, focus on capital discipline, and the current management team is very focused on reducing capex to the lower end of the range this year, and they've dramatically lowered the medium-term capex to 20 to 25 billion, which is about 10 billion lower than it was before. So we think that the go forward Exxon is a much different company than the prior 10 years that you just mentioned.
How high, Janine, do prices have to go before U.S. shale producers, before marginal U.S. Oil drillers actually get back into the market and produce more?
That's a good question. I think that's everybody's fear, is that with higher oil prices comes more U.S. supply. But what we've noticed in our companies, not just on the U.S. major side, but also with the large cap U.S. E&Ps, is that the supply response has been very muted to higher oil prices. And we don't see that changing in the next couple of years. And that goes back to the paradigm shift that we talked about. Investors know that it's a now or never for these companies to prove that they're real companies, that they can return cash to shareholders. And so we think that the supply response will be very muted going forward. Generally speaking, our companies now are much more vocal and aware of the macro conditions around them, indicating that right now the world doesn't need their oil, but they're looking for global inventories to stabilize, they're looking for curtailments to come back, and they're looking for oil demand to come back to 2019 levels before they even consider growth. The one caveat there is we're keeping our eye on private production, given that it's become a much bigger part of the U.S. supply picture.
So, Janine, how much of what you're seeing with respect of discipline has to do with what you're talking about, which is that it might take some time for things to get back to the levels of demand in 2019, and how much has to do with the push by shareholders for climate change activism and some sort of response from the fossil fuel producers?
I think it's both. I think that the capital discipline is alive and well, and we keep seeing more and more data points for that. And I think the push for climate change really is making companies more aware that they've got to look at the overall macro picture. It's not just every company out for itself. And with investors demanding climate change, the energy transition is only going in one direction. So that kind of biases production lower. And let's not forget that investors are really demanding returns and cash returns on and of capital going forward, which historically this group has not done a very good job at.
Janine, what does engine number one want from the Exxon board, Exxon leadership, and do you disagree with them?
Well, we don't necessarily disagree with the nominees that Engine One has proposed. I think certainly they all have merits. And broadly speaking, I think that the market really wants to have change in the Exxon board. So I think Engine One is really looking for transparency and for more energy experience. Where we kind of differ from other maybe opinions is that we don't necessarily think that a major change in the board or the strategy of Exxon would necessarily benefit shareholders. And this kind of goes back to your first question, in that we think the current management team has done a really good job changing the complexion of the company going forward. So between one, maintaining the dividend last year when oil prices were crashing, two, reducing capex to historically low levels from what you would expect them to do, and three, most recently, executing on quarters, we think that the management team is actually doing a pretty good job right now. So a major shakeup we don't think would be the watershed moment that maybe others do. But we do think that the company would benefit from lowering capex further in the near term and lowering capex to at or below the low end of their medium-term budget.
Could you put some numbers on that for us, Janine? And is this upstream capex, and how big would that cut be?
Right, so this is upstream capex that we're talking about. So for example, if they go to about 19.5, 20 billion of capex, we think that they can get all of their plans done in the medium term and produce a decent amount of free cash flow. So free cash flow is really the key for the sector, because that's how you get cash return to shareholders. That's how companies prove that they're real companies. And so for Exxon, if they do that, what we're saying is lowering capex at or below the midpoint of the medium-term guide, we see free cash flow averaging about 3.6 billion per year on average through 2025. And that would allow them to both pay down gross debt and increase the dividend.
Janine, great to catch up. Timely conversation too. Janine Way there, Barclays senior analyst on the crude players, the likes of Exxon and more. Brent crude this morning, $71.17. We approach 69 on WTI at $68 and about 70 cents now. Tom, up by 3.6% on WTI.
As we were speaking with her, Chris Verone publishes a Strategas, and he says he has, quote, his eye on $80 a barrel. What are is anybody framing $80? I don't think so, John.
The rally continues this morning. Crude higher. Equities push up by 23 on the S&P, by 0.55%, and yields up now by 3 basis points to 162.67 as small caps outperforming. That reflationary theme back just a little bit as we kick off the month of June. From New York, on radio, on TV, this is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
From New York City for our audience worldwide, live on TV and radio, this is Bloomberg Surveillance alongside Tom Keene and Lisa Bramwitz. I'm Jonathan Ferro. 1 hour away from the opening bell. Small caps outperforming on the Russell, on the S&P 500 up 0.6%. We advanced 23 points. Your headline at the moment, though, levels we have not seen since 2018 in the commodity market on crude. A 68 handle on WTI at 68.55. And Tom, Brent crude trading at $71 and almost 10 cents.
And it's some commodities. We mentioned that earlier. It's not a broad Bloomberg Commodity Index rise. But, John, there's enough going on there with copper and the rest. They're not out to record highs, but they're right up there and elevated where you really wonder this 56% move in commodities off the bottom of the pandemic. Will it keep going?
Copper's still through 10K, bit softer on the session. Iron ore doing nicely. Iron ore up by more than 4% the last time we saw that trade. Now, Tom, look, China's not participating in this in the way it did maybe 10 years or so ago. And I think it's interesting this morning that China's basically come out engineering, maybe tapping the brakes on its currency appreciation, which you would expect to actually make a dent, take a dent in the commodity market. And this morning it hasn't in a big way at all.
No, and it's just a little bit of a reversal from a 637 yuan to a 6.38 yuan. But nevertheless, there it is as China is active. And you really think, folks, we've got to see more people active. Just as an aside, I'll point out the idiosyncratic Turkish lira out to 8.52, a continued difficult Tuesday there as well. He writes brilliant notes for Pictet of Switzerland, Pictet Wealth Management. We're thrilled that Thomas Kosturge could join us on the American economy this morning. Thomas, my mathematics is a buoyant 6.5% all in this year and a still buoyant 3.2%. We average out at 4.8, 4.9% economy for 2 years running. That's pretty good, isn't it? That's basically double the run rate, right?
Right, and that's what you would expect after strong fiscal spending, several rounds of checks. So fiscal support has been really huge, and to some degree, I think actually the economy could do even better than what it is doing now. The economy is strong, but again, if consumers were really going out and spending all that money that they've saved last year, we could go up 10%. So yeah, we're up 6.5% this year. It could be better, it could be worse though as well.
There can be leakages or surprises within the calculus of what we do. The blunt instrument is we're all going to go out and spend it. No one believes that. What's the leakage within the calculus that you're focused on? What could be the surprise to a more moderate consumption?
Right, and the equation is, we look at the pile of savings. We're speaking here at a pile of around $2.2 trillion, right? Around, 1 trillion that consumers have not spent, and 1 trillion that's the excess income that they got last year because the federal government was so generous. So $2.2 trillion. And the question is, are they going to spend it now? Are they going to wait to spend it? Are they going just to save it or repay the credit card debt? And so far, the indicators we have suggest that there is a degree of caution out there. People are saving. They're still not unsure about the recovery. There's also the so-called haircut effect, which means that if you don't go to the hairdresser once, you don't go twice the following week, right? So what has not been spent will not be spent. But bottom line is that the savings pile is there, but it will probably be spent gradually, which is good. Right, so we have data, we have consumer surveys, and so far they're not that great. Actually, in Europe, consumer surveys are back to their pre-crisis levels. In the US, they're not. If you look at Conference Board consumer survey, the Michigan survey, and even in some details, I'm a bit cautious. If you look at housing intentions in the US, they're actually going down, which is a bit of a worry because, people should be feeling more confident. They should spend, they should buy houses, cars, and so on and so forth. So we have data from consumer surveys, which suggests some caution. We have also data about April spending. So right, they received the checks in March, so we already know what they did in April. And in April, people were quite cautious in their spending. So if we extrapolate that, we have the outcome that I just described, which is strong growth in the second quarter. But after that, we're likely to see growth normalizing back down towards, say, around 4% in the second half of the year.
Thomas, what's the implication if we've basically had helicopter money in the U.S. and even in parts of Europe, and that doesn't lead to sustained inflation?
Right. I think one key conclusion for the next recession is that we may have fiscal policy which may put a timestamp on spending. You may be forced in the next recession, when you receive a check, to spend it within the next 3 months or 6 months. But not like, I mean, the problem with that fiscal spending in the U.S. was that, I mean, there was no, people didn't tell you that you had to put it back in the economy. And I think that was maybe a fragility or a weakness that could be addressed in the next recession. Now, in terms of inflation outlook, you don't see wage growth or, excessive wage growth. You do not see credit growth. I mean, credit growth in the U.S. remains still subdued. And third, inflation expectations remain very much low. Okay, there is an exception in the Michigan survey, but I think that's an exception. Overall, if you look at inflation expectations, they remain very much anchored. So I do not see an inflation phenomenon kicking in. I see inflation in commodities. I see inflation in some supply chains, in some goods and so on and so forth. But there's no generalized increase in inflation.
So just to put together this idea of the conservative way that people have been using their spending, which is or their savings, excuse me, which is what you're signaling with this friction in the labor market, with people not going back into the labor force. Could this be that people are using their cushion to stay home for longer, and that they'll only go back once that cushion is used up? I mean, is this sort of part of the mystery, in your view, that we're seeing in the labor market?
Yeah, and so far, I mean, we had a bad employment report last time. I think we really need to show firmer conclusion. We need to really wait for this one on Friday. I mean, this one will really be key to seeing whether there is a genuine impact from the generosity of the federal government with regards to unemployment benefits. I think it does hamper the return to work. However, it's true there are other issues. One also is that firms have gotten more efficient in this during the crisis and during the recovery. The skills have changed as well. The economy has changed, and so you don't need the same workers that you did. The same ones that you used before the crisis. Think about the green economy. You need a new range of skills for the green economy, and those workers, the skills are not there. So that's I think another issue.
Thomas, your inflation view, maybe it tilts to Jan Hatzius at Goldman Sachs, but I'd really make note that it tilts to David Rosenberg up in Toronto. Rosenberg looks for a disinflation, and he really estimates rather a go east tone. If you're going to buy growth, you've got to go to the Pacific Rim. Does Pictet agree?
Right. I mean, in terms of the recovery, definitely Asia has been, has definitely rebounded much more quickly, and also, a few months ago it was already rebounding. So definitely Asia is the place to go for growth. However, right now the good spot is actually Europe. Europe is recovering. The vaccination is also accelerating. I think this summer could be a good growth for Europe. Now, in the longer run, we're still more optimistic about the U.S. than Europe, including for demographic reasons, but also the technological leadership than we really see in the U.S.
Thomas, thank you, sir. Got to catch up. Thomas Kostek
Thank
there.
you.
Really good.
Pictet,
Really good.
Wealth Management Senior Economist. Just to give you some of the numbers, put some muscle on those bones that Thomas was talking about. The growth for this year decelerating to next year. 6.5%, the median estimate for 2021 growth in America in our survey. 4.0% for 2022. So it's that deceleration from 6.5 this year, the estimate, Tom, to 4 next year, then 2.4 for whatever a 23 forecast is worth right now. Here it is, 2.4% is your median estimate there.
I just emailed up to Toronto and Canada, John, with the same undershooting of the survey. You had 19 economists with a good statistic, and the number came in, first quarter number came in below.
Deceleration.
There's a lot of moving parts here, but what I don't see, John, on the Bloomberg screen this morning is the world coming to an end.
No, obviously not, with futures up 22, 4,200 on the S&P 500. But Tom, the key variable...
I was looking at Doge, but okay.
Were you? Lisa, the key variable has got to be the savings rate. How much more will that come down? how much money will be spent. And when you really dig into it with economists, these are some big guesses.
Well, yeah, and who has the savings, right? I mean, is it the wealthier individuals who have less of a propensity to spend and really more likely to put this in the wealth bucket versus lower income individuals that are more likely to spend it? I think that the implications here have to be emphasized. The idea that if we do not get sustained inflation from helicopter money, from printing trillions of dollars of cash, what are the longer term implications about fiscal policy? I mean, to me, John, this is a massive, massive question that we're going to be talking about for years to come coming out of this year.
It's about time how much you let this play out to see a tighter labor market, which is what the Fed wants to do. They want to wait a long, long time for this. Kathy Jones of Charles Schwab's going to be joining me a little bit later on Bloomberg TV. We'll do that in about 20 minutes' time. We're going to be talking about when you can expect the big jobs number. Is it this week? Kathy thinks August, September. When the schools go back, that's when you'll start to see the big numbers, and you're not going to see them this Friday, Tom.
I don't have an opinion on that, but it's important the way she takes the timeline out. So few people, John, are looking at Q3 or Q4.
Pushing it back to the end of summer, Lisa.
Yeah, well, things haven't gone back to normal fully, and yet there still are so many job openings. How do you square that with all of these people still out of work? I mean, the thing that Tom was talking about, that possibly some of the skills may have changed, I find that really interesting.
We're about to see in 20-plus Republican states, haven't we?
Yeah.
We're about to see over the next couple of months what that looks like with those 20-plus Republican states removing that additional unemployment insurance. From New York this morning, good morning, up 22 on the S&P. We advanced by 0.5% on the S&P 500 to 42.25 in the commodity market, a 68 handle on WTI, 71 on Brent, $68.50 on WTI.
You're going to sing again?
More than 3%. Have you bought tickets?
June, no, I'm not. I'm singing it instead. June is busting out all over.
Nice. Euro dollar
all over the meadow
22.
And the hill.
Yields are up 4 basis points.
Buds are busting out of bushes.
To 163.
In the rampant river.
This is why it's been such a wonderful partnership.
Every little wheel that wheels.
You do crazy stuff and I just ignore it. Futures up 0.5% on TV and radio.
I don't ignore it. I love it.
There, more.
This is Bloomberg.
More, please.
With the First Word News, I'm Rishka Gupta. U.S. oil futures climbed to their highest in more than 2.5 years today. WTI rose as much as 3%. OPEC and its allies are forecasting that the global market will tighten up. The cartel says the oil glut built up during the pandemic has almost gone. And higher energy prices are one of the reasons inflation in the euro area climbed to the highest level in more than 2 years. Consumer prices rose an annual 2% in May. That's more than economists had predicted. A separate report that factories lifted their prices by the most in more than 18 years. And there's a report that Japan will allow some spectators at next month's Summer Olympics. According to TV Asahi, organizers will let domestic fans attend the games. Spectators will be required to provide a negative virus test or a vaccination certificate. Fans from overseas would not be allowed to see the Olympics in person. Krispy Kreme is set to become a public company for the second time. The American donut shop chain publicly filed for an IPO on the NASDAQ. It says that sales rose 23% in the first quarter. JAB bought Krispy Kreme for more than $1.3 billion back in 2016. The company is an investment vehicle for the Rymans, one of Germany's wealthiest families. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The power of Bloomberg. First on news.
Headlines crossing from Morgan Stanley to management shake-up, planning for transition in 3 years potentially.
This is a huge move over at JP Morgan. It is a shock, of course, to the market.
First on earnings.
Apple, a big beat, well ahead of the 33% increase in revenue.
First on markets.
The capitulation phase is buy.
The power of the Bloomberg terminal. The power of Bloomberg television and radio. Bloomberg has it covered.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
One of the chief concerns I have is that as you start to see people doubt the Fed's credibility with respect to its supposed admission on inflation, some of those inflation expectations are rising in a way that's not good.
Dean Kernot, very important there with the VIX coming in as we get closer to the market. Futures up 20, Dow futures up 250. Kernot's VIX comes into 16.69. That's a really important statistic. We'll have to see how that unfolds through the trading day as well. Lisa Bramlett and Tom Keene, John Farrell preparing for an opus at 9 a.m. And what we know for certain is every once in a while, every columnist writes a jewel. And one B. Ritholtz has done that for Bloomberg Opinion. Barry, I loved your column on the Great Reset. And you go to Robert Frank in one of the greatest essays of all time over 20 years ago, led forward by Michael Mauboussin, which is the winner-takes-all technology economy. That's great. How do I do winner-take-all investing?
Well, one way to do it is to look at who the big winners have been and what the trend is like. And up until 2020, that was pretty obviously own everything passively and go with Vanguard and BlackRock. I can't tell, I don't think anyone can tell just yet, was 2020 a lockdown boredom aberration, or have we just flipped the script and suddenly we see the return of active investing and stock picking? I can't help but feel like last year was a one-off, that it's not a sustainable sort of thing. And the big tell for that is going to just be, look at Robinhood volume. Is that going to continue on its incredibly hot path, or is it going to plateau and reverse?
Well, within that, Barry, is a battle. I've had this conversation a couple of times recently, and it goes back to, academics like Toshiya Shande and others, which is sector or individual stock diversification, to use a phrase from the great Peter Lynch. I mean, when it's winner take all, do you do sector focus or stock focus?
So, all the academic data seems to suggest that a tiny, tiny handful of winners drives most of the market performance. And depending on the study you look at, it could be as low as 1%, it could be as high as 4%. But we know that the vast majority of stocks are essentially flat. A handful of small winners, a handful of small losers, and a couple of zeros, and they all sort of offset themselves. So there's only a handful of ways to make sure you own everything that's going to be in that 4% or 1%. You can give your money to the best stock pickers in the world, folks like Bill Miller. The problem with that is we don't know they're the best stock pickers in the world until after they've put up, decade-long track records. Or you can try and pick stocks yourself, and I think the average investor has had very mixed results with that. Or you could just own everything, and that seems to be the trend, at least in ETFs and mutual funds.
Okay.
In endowments, foundations, large funds, large investing pools, they seem to still be in the stock picking modality.
All right. Well, Barry, it's one thing to not pick stocks, but it's another thing to not pick a cycle and not pick the great reset that you've been talking about, how life has changed post-pandemic and what it means for investments. We've seen a lot of themes thrown out there of what may happen. What's sticking in terms of new trends that you can bank on in the post-pandemic reality?
Sure. So I went over 6 broad topics in the column yesterday. And, my cheat is a lot of the things that everybody are all up in arms about and all excited about were really trends that predated the pandemic and that we were just accelerated. Hey, welcome to 2024. Essentially, we're 3 or 4 years ahead of where we were. So what trends are we seeing? Obviously, technology is just dominant, and it's not even a sector now, it's oxygen. If you are not tech-enabled and you are not taking full advantage of technology, you're going to be left behind. So it's not just the tech companies themselves, it's the companies that are deploying technology very effectively. So that's number one. Number two, look, my office has been virtual since we launched in 2013. We have clients and employees all over the country. So the idea that suddenly Zoom is a new thing or screen share is a new thing is really outdated. What last year did was reveal a proof of concept to large corporations who haven't gotten this message.
Okay.
And so while people like Jamie Dimon want everybody back in the office, I think you're still going to see a lot more flexibility, at least amongst white-collar workers, technology workers, more sophisticated companies that understand that to attract the best and brightest employees, especially the younger generation, they have to offer that sort of flexibility.
Barry Ritholtz, thank you so much for bringing me up with the younger generation. Mr. Ritholtz with an important essay there on winner-take-all theory in investing and in economics as well. Lisa, what do you see?
Well, I just was thinking about this idea of how cities have changed and whether the office really is going to come back. And frankly, you're not necessarily seeing the fear priced into markets. People are still thinking of building office towers. Macy's is thinking of building an office tower on top of their flagship store. And I'm wondering who's right. Are we going to see a return to offices in a massive way, or is this a new paradigm shift that we're not seeing accurately priced into markets? I find this fascinating.
You bring it up, and I make a joke about it, Lisa, but it's important. I think we've heard the word paradigm like 7 times this morning, which is 7 times too many. I'm not very big on paradigmatic shifts. I go back to what Barry said, as you go back to February before the pandemic. In some ways, we'll get back to that. In other ways, we won't get back to that. I think the uncertainties here, it's enough to keep you, me, and John in business.
Well, that's terrific. I personally find it interesting to think about the donut theory of cities, that basically the internal city center that used to be filled with offices is getting hollowed out. And this was a trend before the pandemic, and it's getting accelerated, and I think that that's interesting. In the markets, really oil is the main story today, the idea that that OPEC Plus is seeing a tightening labor market.
You mentioned the donut theory. The key news today is the Krispy Kreme IPO.
Have you ever even had Krispy Kreme?
Yes, I have. They have an emporium at Penn Station.
An Emporium.
An Emporium.
Okay, so that's you're going to be buying into the IPO.
I thought
or
Ritica, for those of you on radio, Ritica Group that just nailed the news flow on television. I mean, the crispy, we call it VO, we pros.
You're still stuck on the pictures of donuts.
I didn't even read the notes for the guest after that.
I'm sure. The other interesting
Krispy Kreme report.
The other interesting story was the AMC share sale. The idea that it didn't even dent that.
There we go.
You don't care. You just want to look at
on radio. I'm sorry,
donuts.
Folks. It is vision.
Just wants
I mean,
to see sugar and dough fried.
For those of you on radio, you can envision le creme de crispy.
Oh, dear Lord.
We're talking French, Lisa, when the Montreal Canadiens.
Oh, I heard that. That was great French.
Toronto Maple Leafs.
Yeah, I can't. I don't see you at a Krispy Kreme.
Les habitants magnifiques.
No, oui.
Oui. Yeah,
Carry
that's
on.
all
Look
the
at those
French
markets.
I don't know any more French.
All
That's
right.
it.
S&P
Show is
futures.
over. Au revoir. A bientôt.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. From New York City for our audience worldwide, good morning, good morning. Kicking off the month of June with equity futures positive on the S&P 500. 30 minutes to go. The countdown to the opening bell starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open. with Jonathan Farrow.
From New York, we begin with the big issue, counting down to payrolls Friday.
The jobs report.
That Friday date
feels like a bit of a coin toss at this point.
I would lean a little bit towards the positive side.
Non-farm payroll number comes up decent.
A lot stronger in last month.
Looking for what, 650,000 K versus 266K.
Regardless of what payrolls are.
There clearly is an issue with the lack of labor supply. Wage inflation, very high levels of job openings.
Investors are going to have somewhat a trepidation as we get closer.
The conversations about tapering.
The Fed tapering narrative.
They're starting to drop hints about talking about tapering.
This is never going to be a one and done or a simple move.
Patience is absolutely required.
You had one really surprising print the month before.
We'll just have to see how it goes.
We'll just have to see how it goes. Joining us now is Kathy Jones at Charles Schwab and Fidelity's Lisa Emsbo-Mattingly. Let's begin with you, Kathy. What have we learned from that massive downside surprise from several Fridays ago going into this one?
Yeah, I think the important thing is going to be to look at the averages over several months. The Fed's not going to respond to just 1 month's number one way or another. So we're going to need to see 700 or so per month to get to the Fed's target on unemployment, which is probably full employment below 4%. If it reverts to around 350 or so, it's going to take a lot longer. So right now, I think the expectation is we'll get there by the end of this year because we'll get 650 or 700 a month. But if we don't, that pushes tapering and tightening, down the road. So the important thing is to look at a couple of months average.
Lisa, what's your takeaway from just how violent some of the data misses have been in this market?
I think the data misses are to be expected. And I think about the seasonal adjustment factors that are in place, not to worry about the employment market. I think if you think about corporate profitabilities, they are the key driver of employment. And we're starting to see extremely strong earnings growth across the corporate narrative.
Lisa, can you think of a historical analog here for you, a parallel that makes sense at the moment, or is it still too early?
I think the parallel that I think is the most similar, believe it or not, is the experience that we had as we exited World War II. So the post-World War II narrative was extremely important to think about. Think about World War II. We had the Great Depression. We had a catastrophic war. And as we started to exit that, we had policymakers who were extremely focused on avoiding that occurring again, and that would be the Great Depression. And so the GI Bill, the Full Employment 1946 Employment Act was passed. All of these were extremely focused on creating a upward trajectory in the US economy. And so what we saw as we exited World War II was we went from a high household savings rate and extremely aggressive government spending as we fought the war. Then as the war ended, we shut down the war engine. We had the deepest and sharpest and shortest industrial recession in history. And then as we started to reopen, we had the transfer payments for the GI Bill, we had the Employment Act, and we started to see very strong growth, but very strong nominal growth. And I think the interesting thing about 1946 was at the end of 1945, the average inflation rate for the last 20 years had been 0. In 1946, the inflation rate was double digit, 1947, high single digit. And in the midst of all of that, the Fed sat on its hands. And I think that that's what we're going to see again, is that the Fed's willingness to intervene and start hiking is underappreciated how different the narrative coming out of the Fed is. They really do mean that they are going for average inflation targeting. And so I think it's going to be some time before the Fed is willing to go and put their foot on the brake.
Kathy, does this resonate with you?
Yeah, we've used the parallel to the post-World War II era as well because of the combination of supply and demand shock. I think the difference here, though, is that we do have the same sort of fiscal response on the monetary policy side. I think what we're seeing or hearing from certain members of the Fed right now is more of a push toward, well, maybe we will start tapering. Now, I do think it's going to take a while before they start hiking rates, but what we're hearing from the Kaplans, and obviously these are some non-voters, there's perhaps some reticence about being quite so aggressive on the monetary side for quite so long.
That's the monetary side of the story. On the fiscal side of the story, we're staring down the barrel potentially of an infrastructure bill. Secretary Pete Buttigieg suggesting time is running out. Take a listen.
But the president keeps saying inaction is not an option, and time is not unlimited here. The American people expect us to do something. They expect us to deliver, and it's my hope that these continued conversations, really over these next few days, will be productive and will lead to that clear direction.
Joining us now in D.C. is Bloomberg's Jack Fitzpatrick. Jack, walk me through it. Time's running out. What is the clock? How long's left on it?
Well, we should learn a lot more this week, and I think this week is critical. For one, Shelley Moore Capito, who's the Republican senator who has led the discussions with Biden on this, has also acknowledged that she knows there's a tough timeline. Second, she actually is going to be meeting with the president Wednesday. That was first reported by Punchbowl. My colleague Eric Wasson just confirmed that's going to happen Wednesday. And that's going to be a meeting with the president. The meetings between Senate Republicans and President Biden himself have gone pretty well. So they've gradually started to meet in the middle. There are a lot of things they still need to work out, how much exactly they're going to spend, what they're going to spend it on, and the tax question continues to be very, very difficult. But in terms of timing, that Wednesday meeting is going to be critical, and the fact that Capito has said she understands there's a tight timeline means at some point this week, I think we're going to have a better sense of whether a deal is in the making or if Democrats are going to try to go it alone.
Jack, thank you. Jack Fitzpatrick there down in Washington, D.C. Your bond market this morning. Yields are higher by 3 basis points, the 162 on 10s on 30s. 231 up 3 basis points there as well. Kathy, this conversation about bigger deficits and higher yields, what's the correlation, the relationship? How tight is the relationship between deficits and interest rates in America?
Actually, it has changed dramatically over the years. So we have a scatter plot that we show. And decades ago, there was a high correlation. Now there's a very low correlation. And in fact, what we've seen, not just in the US, but in other developed markets, is that higher debt actually seems to be correlated with lower inflation, not higher inflation. And there's some theories that say that the more the debt load is, the slower your growth is, and therefore that keeps inflation in check. So I don't think debt to GDP is the way to look at it. We typically focus more on debt sustainability. And right now, when you look at where yields are, high debt can be sustained for a period of time, and the Fed has the ability to term out some of that debt and give themselves a runway, say the Treasury, give themselves a runway of 5 to 7 years here where they can finance a lot of spending at low yields. So from a debt sustainability point of view, it's not a big concern. Debt to GDP just hasn't been a good metric to use for a long time.
Lisa, just add to this for us. Historically, particularly over the last few decades, recent history suggests that the higher debt to GDP ratios go in developed markets like the US economy, the lower the peak we've seen in, say, the policy rate at a central bank, and that's just continued recession after recession, cycle after cycle. Lisa, is this one set to be any different?
I think it's going to be hard for most of the major developed economies to exit these types of dynamics that we're in with this extremely large debt load, which any type of upward pressure on yields starts to feed back almost immediately into the real economy. And so becomes extremely difficult to get escape velocity. And so I sort of have described it over the years as the black hole. So Japan was the first place we saw this sort of black hole dynamic where this mix of high indebtedness and weak fiscal financial solvency and monetary policy it gets really, really difficult to get a sustained rise in rates going forward. So I think we're going to be in that type of environment for quite some time. It is, again, interesting to see what the U.S. is doing, where we're going double-barreled into a recovery with both fiscal and monetary stimulus and a high willingness by the Fed to keep rates low and well contained. And so maybe we do get that escape velocity, but I think it's going to be really difficult.
That's the goal, at least. Lisa, you're going to stick with us. Lisa Emsbo-Mattingly alongside Kathy Jones. In your market right now, up 0.5% on the S&P. It's a lift on the first trading day of June. With your movers, it's Taylor Riggs.
It is, John. It's a relatively risk-on day. You want to take a look at natural resources, of course, some of the sectors that are leading. Broadly speaking, oil now the highest since 2018. Hearing from some of the talks that we're getting from OPEC Plus that demand is looking like it might be tightening. So that is indeed helping some of the natural resources, some of the oil producers that you see. Change to the board, and there is a micro story going on as well. Cloudera jumping on reports at KKR, CD&R closing on a deal to take them private, looking at a $4.7 billion valuation, $16 a share. So you're right there as the market thinking that that deal might get done. We have to talk about the retail mania. GameStop and AMC. GameStop up 6 of the last 7 days. You're up from a 170 to 222. AMC is doubled from 12 to 26. John, do you know what a BlackBerry is?
I do, of course. I used to have one.
I have one.
You still have one?
They're making a comeback. The highest since March.
You hope. You hope they do, because clearly this is pretty sad that you've still got one and hardly anyone else does. Do they still have BBM? They still have
Yes,
that?
and
Taylor,
there's a keyboard,
Have you got
John,
friends to BBM?
And there's a BBM.
Do you have friends to BBM
I have
with
one.
on that?
I have one. Maybe you'll be my second.
Okay, if you buy me one, I might think about it. Taylor Riggs there. Coming up, China taking fresh steps to curb gains in the yuan. That conversation just around the corner. From New York, this is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
If you look at the way China's conducting its monetary and fiscal policy relative to the rest of the world, and an incredible contrast to 2008 coming out of that mess, China's being almost Swiss-like in its caution, which one would imagine longer term is probably pretty good for all things China relative to the rest of the world.
China's central bank taking steps to ease the rally in the yuan, forcing banks to increase foreign exchange reserves for the first time since 2007. For more, let's bring in Bloomberg International economics and policy correspondent Mike McKee. Morning, Mike.
Good morning, John. Well, basically what you've got here is China wanting to manage its currency and yet not manage its currency. They basically want to limit volatility and prevent it from rising too much without ending the liberation of the currency, let it get looser to liberalize it and promote its global usage. In recent months, the exchange rate obviously has strengthened. You can see there with the inverted dollar version and the CFET's basket version, we're at a high since 2015, and it seems that it's gone up too far, too fast. So the Chinese today, as you mentioned, putting a curb on the volatility by limiting the amount of foreign exchange banks are allowed to have out there, reducing the dollar supply. They can also tighten derivative use. That's another possibility on the list. Loosen capital outflows. They have capital controls. They could let more money go out or adjust the daily fixing, although a lot of people would see that as manipulating the currency directly. So that is considered probably the last thing they're going to do. Now, all this plays back into the United States because imports from the United States are up, but a stronger yuan is going to make that more expensive. China agreed, of course, to that phase one trade deal under the Trump administration, and they haven't come close to meeting it. Only about 58% of the goal in 2020 so far this year, about 60% of the year-to-date goal. So anything that helps China import more for the United States is going to be seen as good news here.
Yeah, Mike, just quickly, any sign that the strengthening we've seen of the Chinese currency over the last 12 months has done any damage whatsoever to that economy?
It's really hard to tell because of the pandemic, because we see real distortions in the level of trade over the past year, but it doesn't look like it at this point. It's within a range that we've seen over the last 5 years. They just don't want it to go too far, too fast, and it started to pick up speed in the last week.
It's about tapping the brakes, maybe, instead of reverse engineering what's happened. Mike, thank you. I want to bring back in Lisa Emsbo, Matt Tingley, and Kathy Jones of Charles Schwab. Lisa, the work you've done on cycles, I think, is really valuable here. This one's different from the last one because of China's participation in it previously and lack thereof this time around. How important is that dynamic for you, Lisa?
Oh, I think China is super important. Over the last, let's call it 15 years, China has become a really important economy to watch in terms of the global driver of industrial activity, et cetera. And so what's so unusual about this cycle is I would actually argue that the tables are turned and the role that the US is playing is very similar to the role that China played in 2009, 2010. Massive fiscal and monetary credit stimulus, a booming sort of bounce off of an extreme low, and China was the driver of the global cycle for the last decade. I think that the U.S. is starting to play that role much more strongly than China has, and so the tables really are turned. Where I think the U.S. dollar, as a result, is going to be under downward pressure. The Chinese currency, as we're hearing a lot about today, is under upward pressure. The Chinese are trying to stabilize their financial system, keep things in order, and that leads to this upward pressure on their currency, which has positives and negatives for them.
Two pieces to the story then. You touched on the FX part of it. Let's talk about the commodity part of it as well, and I'll return back to foreign exchange. Kathy, the Goldman view is similar to Lisa's. It says, quote, the velocity of the developed market demand recovery means that China is no longer the marginal buyer dictating pricing. Just to build on that, Kathy, do you think the US can take that role that the Chinese economy had coming out of the last crisis?
Well, I think we have taken the lead, and a weaker dollar is a big component of that. A weaker dollar is associated with stronger global growth, and it's very pro-cyclical, especially for emerging markets. I don't know that we have the capacity to be as powerful in our imports this time around as, say, China might have been as a driver in the past cycle, just because China's, fiscal balances were much easier for them to cope with, and the fact that their currency at the time was quite undervalued. I think for the U.S., we certainly can lead the cycle. I don't know if we'll be as powerful as China was in the last cycle.
Lisa, on the FX piece of this puzzle, you mentioned dollar weakness there. Nobody wants to be the stronger currency on the other side. Europe does not, China does not. How does that play out?
I think it's tough. I think everyone wants to be a weak currency, and so you have to start thinking about real assets and where are those real assets. It can be commodity prices. We're hearing about energy prices today, but of course we've heard about lumber prices, even used car prices. Used car prices are up more than 30% year to date. Real assets really start becoming very, very important in this type of dynamic.
You think it's more than just a short-term shortage story, that it's something more than that? There's a cycle call here, Lisa.
I think there are a lot of things that have changed again since 08, 09, and I think that one of the biggest things is the willingness of China to produce goods at either no profit or very little profit. That is, I think they have stepped away from that very aggressively. There are many reasons why they've done that. One of them is they want to have a cleaner economy. They want to reduce their carbon footprint. So they're no longer willing to produce, for example, steel for export in dirty industries. And so I think the supply side controls that we're seeing out of China actually accentuate some of the inflationary impulses that we're seeing. I think there's a lot of other things that are potentially inflationary here in the United States. Every single small business survey, CEO survey indicates how tight the labor market is. We saw the JOLT survey, extremely high job openings. And I think that the reservation wage, what economists would call the reservation wage for the labor force, has gone up. And so the corporate sector is going to have to pay up for labor. And, you know, these are some of the attributes of not a hyperinflation environment, just a generally higher inflation environment. And that's what the Fed is looking for. And they're going to get it. They might, once they get it, not be particularly pleased with the results. I think one of the things that I thought was interesting was the University of Michigan survey that came out. And you saw that the first signs of perhaps a stagflation signal, where the willingness to buy homes, to buy cars, et cetera, fell quite dramatically. Inflation expectations are just at either a decade high or multi-decade high. So I think it'll be very interesting to see how the Fed navigates the environment as we go through it. I certainly don't think we're going to have double-digit inflation, but I do think that the Fed is going to have to think hard about what they think of the inflation rate once they get it.
Higher prices could well weigh on demand. Lisa, we've got to leave it there. It's great to catch up. Thanks for being with us today. Lisa Emsbo-Mattingly alongside Kathy Jones. Coming up, the morning calls and later, mounting signs of caution. Investors moving to cash and snatching up protection. That conversation still ahead. With BMO's Brian Bowski and Academy's Peter Cheer from New York, this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Minutes away from the opening bell in New York, all-time highs on the Stock 600 over in Europe. On the S&P 500 stateside, futures advancing 0.5% on the S&P. The Nasdaq up 0.4%. That's the price action. Here are some morning calls. A look at some of the analyst recommendations on Wall Street this morning. We begin first up with Cowen upgrading Boeing to outperform with a 290 price target. The analyst expecting higher vaccination rates to improve aircraft demand. We're up there by more than 2% in the pre-market. Your second call comes from the team over at Bank of America, upgrading Williams-Sonoma to neutral with a 180 price target. The analyst expecting key competitive advantages to boost the company's earnings growth. We're positive there by 1.94%. And finally, UBS downgrading News Corp to neutral with a $35 price target. The analyst citing the stock's valuation following its recent outperformance. We're negative there 0.8% at 26.77 in the pre-market. Coming up, investors growing increasingly wary of volatility. That conversation up next with BMO's Brian Balsky and Academy's Peter Cheer. As we count you down to the opening bell this Tuesday morning, 4 minutes away from the cash open to kick off trading in the month of June after slim gains in the month of May. We are up to 42.25. We advanced 22 on the S&P. We're up 0.5%. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
24 seconds away from the opening bell in New York City this morning. Good morning. As we kick off trading for the month of June, equities firmer, up 25 on the S&P 500. Outperformance on the small caps. The Russell up by about 0.8%. And we advance on the Nasdaq by 0.5%. That's the opening bell. Switch up the board and get to the bond market. Your 10-year yield in and around 161, 162. We're up 3 basis points on the day to 161.98. That's the story of the bond market. FX, euro dollar, bit of a snooze, 122.29. ECB decision next week for the euro side of the trade. For the other side of the trade, we will have a Fed decision the week after that. Commodity might be the story this morning in crude. WTI up 3 percentage points to a 68 handle on WTI. Brent at 71. That's the cross-asset story this Tuesday at the market desk with your movers. Here's Bloomberg's Katie Greifeld.
Well, John, like you said, energy is your early winner this morning. That's after crude futures rose to the highest level since 2018 after OPEC forecast shrinking supply. And as a result, Chevron, Occidental, they're out front early. And it's not just oil. U.S. Steel and Freeport-McMoRan also gaining as metals broadly rise. But also in the green this morning are travel companies, with airlines and cruises gaining as we get closer and closer to normal, John. We learned last week that Royal Caribbean was approved for its first post-pandemic cruise in June, and U.S. air traffic over the weekend was 457% higher than a year earlier at one point. And it looks like that's helping to lift the entire travel sector today. And finally, John, we have to talk about meme stocks because AMC this morning announced that it's selling over $230 million worth of shares to Mudrick Capital at $27.12 per share, above Friday's closing price. That's boosting AMC this morning after the stock nearly tripled in May alone. And it looks like it's bringing GameStop along for the rise of about 3.5% at this point, John.
Up 17% on AMC. Unreal. Katie, thank you. We'll catch up with you a little bit later. In the early part of the session, AMC getting up to 30, 70-ish. We'll try and keep up with that through the next 30 minutes. Elsewhere, the S&P 500 up 0.7%. Energy advancing top of the pile, up by 2.55%. Healthcare bottom of the pile, just slightly negative on the session so far. Equities mounting up a little bit this morning, edging higher through the month of May as well. Beneath the surface, are we seeing some signs of caution? With more, here's Bloomberg's Taylor Riggs.
Despite some of that retail mania, there is some underlying hedging, maybe some protection going on, John, that tells a little bit of a different story than some of the mania that we continue to see. Take a look at the skew index, now rising to a 3-year high, showing signs that investors may be a little bit nervous, trying to protect themselves. Remember, the skew index tracks that cost of that tail risk, equity protection, that left side, that downside risk. All of this comes, though, John, if you take a look at the term inside the terminal, the chart in the terminal, trading ranges are getting narrower and narrower. In the last few months, we've pretty much done nothing really on the S&P. There hasn't been a real catalyst. May, you had 0.5% of a gain. That was the smallest for any May going back since 2001. And you do see some of the signs of pulling back. The SPY has seen $10 billion in outflows for the first 2 months of the second quarter. That is the most since the COVID panic, John.
Thank you, Taylor Riggs. Morgan Stanley's Mike Wilson saying inflation expectations have likely surpassed achievable levels, writing the following: inflation is on the upswing in our view and will eventually surpass the Fed's targets on a sustainable basis. However, expectations have increased too and now price this rise in many asset markets. With May's CPI release much anticipated on June 10th, we suspect this could end up being a sell the news event that could negatively affect many crowded trades. Joining us now to discuss some of these themes, BMO's Brian Bowski and Academy's Peter Cheer. Brian, let's start with you, sir. A narrative that has gripped this market, just in terms of market participants on shows like this idea of peak growth. How important is that, Brian?
Good morning, Bloomberg. Thank you so much for having us, Jonathan. I think peak anything is always a very difficult type of measurement to look at, whether or not it's peak valuations, peak margins, peak earnings. I think anybody that thinks that they can peak to trough or trough to peak invest is foolish. I think to try to time the market is foolish. And I think by and large, you have to work more with trajectories, Jonathan. I think the trajectory of earnings continues to be higher. I think the trajectory of stock prices are going to be higher. The issue is, I think we're too academic in how we're running portfolios. And we have to understand that we're transitioning away from multiple expansion-driven markets to more earnings-driven markets where inherently, historically, and academically and fundamentally, Earnings-driven markets are slower in terms of performance. And so I think the market can, will, and should likely muddle along like it did in May and in June most likely as well. And then once we get a better picture on what third and fourth quarter earnings look like, and this whole notion of inflation expectations heading into 2022, I think the market is higher at year end, and that's why we upped our number to 4,500 a couple of weeks ago. But we're still very bullish longer term. We still believe that North American equities are the place to be with respect to equities in terms of worldwide equities.
Brian, within that call, that upgrade, where did energy sit?
Energy is neutral. You know, we were wrong to be underweight energy in the beginning of the year, quite frankly. And we think it was more of a momentum play, quite frankly, than fundamentals. I mean, obviously, supply and demand are roughly balanced, and I know OPEC came out and started to cut supply, but at the end of the day, this was a sector, we think, that was excessively oversold. It was a trading bounce. From a fundamental perspective, we still think there's way too much capacity, especially with respect to U.S. energy. We like Canadian energy a lot more.
Peter Chair, I want to bring you into the conversation, and we'll start with where I started with Brian. This idea of things are as good as it gets, and Brian really pointing out that earnings revisions aren't. They're still getting better. Margins were great in Q1, despite the cost pressure. Is that something that can persist, those supportive factors behind this equity market, Pete?
Yeah, I think we're sitting here and all trying to figure out what's going to come out of D.C. next. Definitely fiscal stimulus and the hope of fiscal stimulus was one of the driving factors. It seems less clear what we're going to get out of D.C. on that. And we're also seeing some consolidation. The S&P was marginally up last month. The NASDAQ was marginally down. And as you went to some of those real high-flying stocks, they were down fairly significantly, 5 to 10%. So I think there's a little bit more of that trade to continue. And then I think we want to get back into those high flyers. I think it's going to be an interesting environment. I do expect inflation to continue, and some of this rise in energy price is really ESG related, right? There's pressure on some of these energy companies not to produce as much oil. So I think that's going to be inflationary. I think people are going to misjudge how persistent inflation is. So that's a concern, but I don't think it's going to be enough to knock the stock market down.
What was your take on what happened with Exxon last week, Pete?
I think it's the shift to these large energy companies are going to look more sustainable years down the road. I think they're actually going to be great investment opportunities, right? You get to buy their scientists very cheaply. You get to buy their production knowledge very cheaply. So I think that's going to be the sustainable energy companies, or the types like them are going to be that of the future. You're seeing some of the same stuff on auto. So that's been one of our themes, is not to focus necessarily on the sustainable companies of today, especially the small ones without a big management history, and really look for those companies that have that know-how and are turning it around. And I think they're going to be the leaders in the coming years, and that's going to be a great investment opportunity. We continue to like those types of companies, and I think this Exxon news fits that narrative very well.
Brian, let's build on it, away from the energy players, the type of companies you want to own, the type of companies you think are going to help take the S&P 500 to 4,500.
Well, I think Peter's spot on with respect to how to use that template. I think the template for energy is going to buy the big energy companies because they have the R&D. You buy the big financial companies because they're going to buy the best financial apps. And you buy the big tech companies because they have the most cash to buy the new up and coming companies. I think it's going to be a combination, quite frankly, of earnings stability, earnings quality, earnings sustainability in terms of low standard deviation, in terms of quality of earnings, and that brings you to tech. I think tech's got another big win in the second half of the year, and for the next 3 to 5 years, if you want a 3 to 5 year call, our favorite sectors are technology, communication services, and consumer discretionary, because that's where we're spending the money. But between now and year end, I still think it's financials. Financials, we continue to believe, are way under-owned in our institutional portfolios around the world in terms of our clients. We think there's still a lot more to go there. We think it's actually the best sector in terms of growth at a reasonable price.
This is something many people struggle with, Brian. They look at performance and they decipher ownership from the performance. So if you look at the performance of the banks this year, fantastic. Year to date, fantastic. Last month, too, up another 5% on S&P 500 banks. How do you get a better read on ownership, Brian?
Well, I mean, the best way is actually to reach out and talk to clients. I know that's kind of a novel concept in terms of actually speaking to a client versus reading surveys or all this sentiment stuff. the best gauge of what a client is doing is actually look them in the eye and answer their questions or do bespoke research for them. And we think that our clients around the world are still underexposed to the big banks. We think the money center banks, the brokers, the asset managers, where scale is, you have to have scale in financials. And let's face it, I know that there's a lot of inflation fears, but rates are still low historically, and it's tougher for regional banks to make money in this lower rate environment, and that's why you want to be in those scalable assets like the money center banks, like the brokers, and like the asset managers.
The bank sector on the S&P right now, record high on the S&P 500 for the bank sector. Peter Cheer, just a final word on that, please.
Yeah, if anything, though, I focus more on European banks. I think there's a lot of upside there. When you look at them, I think we could start seeing some ratings upgrades from the credit standpoint, which, again, be very, very supportive for the equities. So I like the European banks probably a little bit better right now than U.S. And on tech, the one concern I still have is, will the Biden administration find a way to pass higher taxes onto them? I do like the fact that Ireland effectively told us no, and that they were not willing to, give up some of the tax breaks Ireland's giving to companies. So that's something I'm closely watching, because I do think that tax initiative could be a problem for big tech. So far, though, it looks like we're not going to see that.
The threat of regulation, the threat of higher taxes, Brian, we've been dealing with that for a number of years now. Any reason to lend it greater credibility this time around?
No, I don't think so. I think big tech will just take out their checkbook and write a check if that's what they need to do. I don't think there's going to be regulations on that. If anything, you saw the government still wanted to come after financials, which I think is more of a sideshow as well. I think they've got other fish to fry, and I think it's mostly going to be taxes, quite frankly. It's going to be less about regulation, more about taxes.
Brian Bowski, Peter Cheer, sticking with us. Let's head back to the market desk. Your S&P 500, 0.4%. With your movers at the market desk, here's Katie Greifeld.
Well, John, let's stick with those banks because it's turning into a great day for the reflation trade. You have Treasury yields up across the curve, and as you would expect, that's lifting financials with JP Morgan, Bank of America, Citi, Goldman. All of your big banks are in the green so far today, John.
Katie, thank you. Coming up, breaking US PMIs crossing in just a few moments' time. More on that still ahead with Mike McKee of Bloomberg to break down the numbers, and BMO's Brian Bowski with Academy's Peter Cheer. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Traffic. Okay. During the pandemic, no traffic. Okay. Where do you see the oil market in about 20 years or so? Non-existent.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
This is not the time to worry about inflation, although one should always keep it in the back of our minds, just like it's not the time to worry about debt. Why? Because the enemy's still there. Because the virus is having immediate consequences on the economic side, on the social side, and those will stop the moment we stop the virus.
The OECD dismissing rising inflation concerns this morning. Some data from America. We're looking at a PMI that is better in the month of May. With more, here's Mike McKee. Morning, Mike.
Good morning, John. The market U.S. manufacturing PMI, these are smaller, more export-oriented companies necessarily than the ISM, which we'll get at the top of the hour, comes in at 62.1. That's a little bit down from the preliminary 60. That's a little bit up from the preliminary 61.5. So some good news there. When you get into the 60s, does it really matter? You're looking at Europe, and it's confusing because some of those countries have preliminaries and some don't, but basically the numbers are all good across the board in the Eurozone. Germany, the index is down a little bit. It was 66.2 in April, but a year ago it was 36.6. That gives you some idea of how far we've come in the past year. The only one that was worrisome was the UK. It fell during the month, but new orders rose to 68.1 in the UK. That's the highest ever, John.
How useful is some of this data right now, Mike? There was an interview with Jim Bullard of the St. Louis Fed and the FT this morning. He said the jobs market is tighter than it looks. Goes on to say that he's starting to advocate for the Fed to look at other measures of job market tightness, particularly the unemployment to job opening ratio. Your response to that, Mike?
Well, he's not alone in that. Most of the Fed are looking at a dashboard of different labor market indicators because they don't think the unemployment rate gives us a true picture of what's out there.